that they're working on key legislation. They haven't entirely given up on some portion of Build Back Better. And you look at the congressional schedule, this could get late into the year. I think they face a time crunch, and they could simultaneously be trying to push forward major legislation at a time when they want to get out on the campaign trail. They're going to get even more into campaign mode over the next few months. The question is, how quickly do they get there?
Jack, you are welcome back.
Anytime. Thank you,
sir. Jack Fitzpatrick down in DC. We appreciate it. Tom, you and I have been talking about this over the last few weeks, that the big issue we've discussed on a program like this with an international backdrop, the geopolitical tension between Ukraine and Russia, and that makes sense. Domestically, the focus is on education, crime, and inflation. And what's interesting today, as you go through the president's agenda here in New York, it's on crime, it's on education. And Tom, that's where the focus is domestically for the electorate.
The heritage of this for those younger, and I'm going to suggest it goes back to the late 60s, early 70s, where basically Richard Nixon, John, co-opted this theme from the Democrats, and people have never forgotten that. And when necessary, as there seems to be a crime concern raised up in America, it all of a sudden comes out of nowhere and launches front and center, and that's what we see today.
And this is a subject, a topic, Lisa, where the Republicans at the moment are having great success.
Look, nuance doesn't work in American politics. And right now, some of the issues that are facing the nation are pretty nuanced. So if you can come out and just say someone's not doing a good job, it's a message that actually gets across. In terms of how you deal with it, it's a lot harder to know. And we've seen that from some of the fractured messages across the administration.
John, I want to dip into this really quickly. This is Thomas Bach. What's cool about him running the Olympics as head of the IOC is he's a gold medal winner. I think that's really cool. It's not like some business guy flacking. This is a guy that actually won medals for West Germany a generation ago in fencing, and he's the one front and center for the IOC. And you know, John, there's going to be some politics injected into this.
Oh, in a big way, Tom. And there's already massive pressure on the likes of NBC, BBC, leading the coverage of this event to bring up the issues of human rights abuses in the country. And it's going to be a big issue for the next few weeks, and as we know, beyond in that country. From New York City with futures negative a little more than 1%, with Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures are negative. The Bank of England and the ECB just around a corner. This is Bloomberg.
going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
You can turn yesterday upside down. Your equity market lower on the S&P, down by 1.2%. What the likes of Facebook is doing for this market, Alphabet was doing for this market, the opposite yesterday. The Nasdaq 100 down by 2.3%. It's all about one name at the moment, just souring sentiment. Again, a mega cap having a mega move. Why? We're going to focus on that. Some really whippy price action. Let's take a look at Facebook just quickly. Down about 20% in the pre-market. Right now down 20.93%. Meta Platforms, Facebook getting hammered. We'll talk about that later. I want to talk about the bond market too. Let's focus on twos at the front end in the UK, the US, and we can do Germany as well. Touch on Germany later. Let's focus on the middle of that one, the UK. The yield on a 2-year gilt at the moment is north of 1%. 12 months ago, it was negative 8 basis points. Just think about that change, how quickly things have changed, Tom. We're looking at a second interest rate hike from the Bank of England. Last time 15 basis points, this time 25. That would be the first time in 17 years that we've had back-to-back interest rate increases at the Bank of England. And that was before Danny Blanchflower's time, Tom, at the MPC.
It's interesting here, John. Each of these stories is so different. I think to bundle them together is really incorrect.
I would agree with you. You mean UK versus, say, the US and Germany, Tom?
ECB, I think each story is shockingly different and nuanced.
I would say the UK is closer to the US, Tom. The ECB is really trying to remain patient here and hold the line, and that's the test for President Lagarde a little bit later.
Let's get to it with a conversation here. We're thrilled to bring you David Blanchflower. He's professor at Dartmouth College, definitive on our labor markets, definitive with his classic book, The Wage Curve. We're thrilled that Danny Blanchflower could join us, and of course his experience with the Bank of England. David Blanchflower, I want to start with the ramifications if central banks pause each in their own way. If the Fed doesn't raise rates 14 times or whatever the call is, if, as John mentions, BOE goes up twice and then pauses, or Lagarde pauses and never gets started, what happens to us if central banks pause?
Well, you're right. I mean, they don't seem to really be in concert. I mean, we've got the ECB that was always so hawkish is now the most dovish. The Fed not raising rates, the bank raising rates today. I think the answer is we're all hurting. It's unclear what the data looks like, but inflation is raging and real wages are being hit. So people on the street are being hurt considerably. I mean, the reality is inflation hurts, unemployment hurts. The alternative to inflation is also hurt. So obviously this is the world that we're in. Man on the street, woman on the street not doing so well. Central banks not really knowing what to do. Inflation is rising,
right?
But real living standards and the consumer confidence is falling and real wage growth. So the answer is this is very complicated. But essentially, the economics, in many ways, is going to drive the politics.
How?
The politics in America, the politics in the UK are being driven by the fact that standards of living are being impacted.
Describe the history and the present reality of raising rates given negative wage growth. This is your wheelhouse. How do you affect that policy?
Well, it's not. This is obviously a tough situation to be in. I mean, the Bank of England's communications, the last two meetings, the first meeting they said they were going to raise rates and didn't, and everyone thought at the last meeting they wouldn't raise rates and they would. I mean, so the reality is a complicated place. I just don't think we really understand what's going on, and we're going to see a decision in a minute, which is pretty confusing. So I think the communication is what's driving everyone's confusion. The central bank doesn't know what it's doing, and their credibility is kind of shot, Tom. So I really am concerned about what you would do in this world of real wage declines, people feeling pretty tough, and the suspicion is you raise rates and real wage is going to fall even further. When I was looking today in the UK, basically what's happened to wages. 6 months ago, real wage growth was about plus 6%. Today, it's -2%. So these are very rapidly changing worlds. Perhaps the world that the Bank of England is looking at in terms of trying to raise rates is because of the worry of exploding wage growth. But that's not the world that we're in. So I think we're just in a world of complete confusion, Tom. And the labour market is going to be central to this and a problem.
Well, Danny, what's bizarre about this moment in the UK, as you know, and we can discuss this.
Right.
When I get the call later from my mum and we talk about what's happening, she's not going to ask about the Bank of England. She's going to talk about gas and electricity, without a doubt. And Danny, isn't that the bizarre moment we're in at the moment? Ofgem, let's be clear, Ofgem, the UK energy regulator, have put up the cap on energy prices. Right. At the same time, we're going to get the Bank of England raising interest rates, and then the Chancellor's going to try and offset some of that, Danny. I mean, what are we doing here in the UK?
The Chancellor's going to try and offset it, but at the same time, there's a rise in the national insurance tax in April, and so you're raising job taxes. You're dealing with this rise in energy prices. You're trying to offset it. You're trying to deal with the fact that these energy companies are collapsing around us. And then the other thing is there's a big debate in the UK. So all the oil companies are doing incredibly well. And there's a big debate shared across the political aisle that perhaps the thing to do is to have a windfall tax on the profits of the energy companies. Whether that happens, who knows? But it's politically more viable, if you like, than taxing jobs. So the politics here and the economics are intertwined at a time when the British government and the Prime Minister, after Partygate, are in a lot of trouble. But you're right, people are really going to care about energy prices, and this is going to impact the popularity of the government and probably whether the Prime Minister survives.
So amid all of this muddle, if you were still a Monetary Policy Committee member on the Bank of England, what would you do?
Well, I think what I would probably do is sit pat and perhaps think about maybe not reinvesting the maturing assets that are coming, but taking it slow. I mean, the contrast with the United States, why are you raising rates in this confusion when you really, I mean, the crucial thing for the markets today will be, what's the Bank of England signaling that's coming? And the answer is, well, they don't really know, but it's going to impact on their behavior. I think what I would do would be, I think I would probably say, perhaps we'll allow we will not reinvest these assets, but we'll sit and we'll wait and we'll look and we'll say, we really don't know what's coming, because we have no historical precedent for this. In some sense, that's the Fed's position and it's the ECB's position. And I think what the danger will be, we'll see the Bank of England raising rates and perhaps raising them again, and then in 6 months' time having to go, oops, and reverse it. So I think the thing you've got to try and do is have a consistent story so you don't really know, you're waiting and watching. I mean, a small rate rise today perhaps won't do very much, but people are really hurting. And so to add to that confusion, add to the confusion that John's talked about, rising energy prices, taxes coming up, more people going to food banks than have ever been, worried about paying their bills. I think I would sort of try and stay out of the politics.
Danny,
wait.
it's hard to stay out of the politics, though, when inflation is in the forefront. And you see that not only with the Bank of England, but also the United States, and, of course, the ECB. In the U.S., there is a divergent story, particularly from the ECB, where basically there's a belief that the longer inflation remains at this pace, the more people's belief in inflation will cause it to become even stickier. Why is that not the story in Europe, given the fact that, yes, I understand the wage dynamic, but everything else is going up?
Well, I mean, I do think that what goes up does come down. I mean, I was just looking actually before we came on. I was trying to look back in the UK when the last time we had inflation above 5. And surprise, surprise, it was actually in September 2008. It was about the same, 5.5 or so. Within 9 months, it was down to 1. So the expectation, in a sense, is that what goes up actually does come down. In the past, it came down. So I think the answer is people can change their spending patterns. People can stop buying things. Ultimately, I would expect to see inflation is going to come down, especially if the economy is slowing. And what's a slowing economy going to do? It's going to reduce demand. It's going to reduce prices. And so my suspicion is that actually in a year's time, we're going to be talking about very low inflation, not very high inflation. But that's a credible possibility, and the Bank of England can't ignore it.
Danny, final question. We'll do the Bank of England decision in about 20 minutes' time. I promised that I would ask you this question. We've been talking about it for weeks. When you are criticised, you're often criticised because you stick to the same script all the time. And I want to understand, our audience would like to understand, what conditions you would need to see in the United States for the Federal Reserve to raise interest rates. What conditions would you need to see, Danny?
Well, I want to see a strongly tightening labour market, and I want to see it based upon things like the employment to population rate. I mean, the consistent story I've told is it looks to me that the US economy is a very long way away from full employment based upon employment to population rates. There's been a temporary shock going on, but I would be waiting to see what adjustment has taken place. I mean, if you look simply at employment to population rates, my guess is the US economy is about 8 million jobs below full employment. So waiting and watching and being careful seems the right thing to do. And then given that forecasting is impossible, and I'm very concerned about the collapse in consumer confidence. So, I mean, which now predicts recession. Whether that's true or not is another issue. But I think the misunderstanding of what's happened in the labor market, and the Fed has admitted that 2015 to 18 it raised rates wrongly because it got full employment wrong. So I'm still waiting to see the labor market showing signs of vast employment growth. But obviously right now there are issues, and I think I would probably be pretty darn much on where Powell has been and being concerned about whether inflation is embedded. But I don't think it is. I think it's going to start to plummet like a rock.
I'm looking forward to your tweets in about 20 minutes, Danny. Thanks for being with us.
We'll see what they do, and we'll see whether it's unanimous.
Danny, thank you, sir. As always, the Bank of England decision, about 19 minutes away. A minute after that, I think that Twitter account, Lisa, is going to be very active.
I love it,
Danny
honestly.
Blanchflower.
Honestly, he has sort of a gloomy outlook, which I can relate to. It's just sort of, you kind of...
Any surprise, Tom, that Lisa loves it?
It's just,
you don't?
It's
spiral of...
what it is.
Futures down by more than 1% on the S&P. The Nasdaq off by 2.25 from New York. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. We're likely to see one of the biggest one-day market cap wipeouts for any company ever. Facebook parent Meta Platforms is set to lose about $180 billion in market value. Shares are down some 20% in pre-market trade. The company gave a first quarter forecast that missed estimates and cited stagnating user growth. In the UK, the cost of living squeeze just got worse. British domestic energy bills will soar 54% in April. That's a dramatic blow to households already suffering from inflation. The UK's energy regulator lifted its cap on bills in response to a surge in gas prices that has put dozens of utilities out of business. All three of President Biden's nominees to join the Federal Reserve say they place a high priority on tackling inflation. Prices in the U.S. are rising at the fastest rate in almost 40 years. Philip Jefferson, Lisa Cook, and Sarah Bloom Raskin appeared before a Senate confirmation hearing today. In prepared remarks, Cook called the fight against inflation the Fed's most important task. And Shell posted fourth quarter earnings that blew past analyst expectations thanks to surging energy prices. The company says it plans to buy back $8.5 billion of shares in the first half of the year. Shell had already promised to raise its dividend by 4% each year. And how big is Jeff Bezos' new super yacht? So big that when it leaves a Dutch shipyard where it's being built, a bridge in Rotterdam will have to be temporarily dismantled to let it go through. The bridge's central span can be raised 130 feet in the air, but that's not enough to accommodate the yacht's 3 giant masts. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
So globally, cases continue to rise, right? We've seen a 14% rise in cases over the last 2 weeks. Similarly, globally, deaths continue to increase. We're a global society. So what happens in other countries matters here in the United States of America, and we have to watch very carefully.
Wasn't it brilliant to catch up with Dr. Bhakti Hansati yesterday, the Johns Hopkins Associate Professor of Emergency Medicine, with Tom Keene and Lisa Bramberts. Your equity market is down 328 on the NASDAQ. We're down by more than 2%. Facebook getting hammered. That's the story there. On the S&P 2, we pull back by 52 points. 4-day winning streak into Thursday. Then we pull back by more than 1%. Treasury market behaves 177.52. 2 central bank decisions still to come. In 12 minutes' time, we get the Bank of England. 45 minutes after that, Tom, we get the ECB.
It's going to be really interesting to see it. Of course, 2 different stories there. It's good to have John here with his expertise on it. And I believe, is Madison's in Frankfurt, John?
We've got Manus in Frankfurt, and I think we've got Lizzie Burden outside the Bank of England,
Cool.
Tom.
So we'll have that covered for you here
covered
in a bit. Let's do the pandemic right now. Christian Byers has been wonderful for us, international epidemiologist coming to us from South Africa. And what's important to me, Dr. Byer, is Cape Town is 7,300 miles from Auckland, New Zealand, and everybody in your game is focused today on New Zealand, where they actually announced a plan to quote-unquote open up New Zealand. How far are we from other nations saying enough, we're done, we're going to open up? When does America, when does the United Kingdom or France, name the country, when do they do a New Zealand?
Well, I think in this region, and as you said, I'm here in South Africa today, we lifted more restrictions in South Africa. We're seeing, I think, a number of countries, Botswana, Malawi, Zimbabwe, around South Africa, also in this post-Omicron, post-Delta position where so many people have had the virus. Vaccine coverage is low, but nevertheless, we're really coming out on the other side. So I think in this region, you're going to see more restrictions lifted. Remember, too, this is a really young part of the world. So Malawi, for example, the median age is 18.
Wow.
They should never close schools again. It's just, that is not going to happen, and it shouldn't happen. We're different in the U.S. We knew there was going to be a lag. We knew there were going to be this hospitalization wave. We knew there was going to be this loss of life. And we had, yesterday, 3,600 deaths. So we're not out of it yet. And we still don't have high enough immunization rates, and we still don't have high enough boosters, particularly for people over age 65. So that's a big part of the reason why we're not there yet.
How do you respond to the regional nature of the recovery in the United States? How does a pro develop Northeast, Midwest, South, Far West, all the different regions you people are expert on? How do you adapt to that into March and into July?
Well, I think you're going to see that the declines in the places that had Omicron first, like the Northeast, New York, New Jersey, Connecticut, are going to continue to go down in terms of new cases. We're still in parts of the country where Omicron continues to surge, and the hospitalizations and the loss of life are going to follow that in the same lag fashion. I do think that we will, as a country, be in a very different position, certainly by the end of February, early March, because if, barring another variant with even more transmissibility or immune escape than Omicron, we will be coming out on the other side of all of those regional spikes. And I think, as we've seen before, and hopefully we'll see again, the warm weather is going to change the dynamic as well. And of course, we now have some other big changes. Moderna got full approval for their mRNA vaccine. Novavax has applied for emergency use authorization for their protein subunit, over 90% efficacy. And of course, we now have applications to the FDA for the under 5s.
Yeah.
So all of those are going to matter.
Dr. Byer, can you game out what's going to happen as we kick off the Olympics tomorrow in a nation that really doesn't have a collective immunity and that is trying to make inroads with respect to new vaccination cycles, but has not really reached critical mass yet?
Yeah. Well, when you contrast, for example, what's happening in this region where there never was high enough vaccine coverage, but where there was so much more transmission, so many more people got infected, and these are young populations, China looks terribly vulnerable. Because they went with this zero COVID approach, and because their initial vaccines, the Sinovac and Sinopharm, turned out to be low efficacy against the new variants, Delta and Omicron, they're really not protected. And so despite their very strict approaches and control and intense surveillance, what they have is an enormous number of people who are vulnerable to this virus. And that now looks like a vulnerability, particularly as the Olympics get going.
Dr. Chris Barra, as always, sir, thank you. Thank you very much. From Johns Hopkins Bloomberg School of Public Health. Turning back to the UK, in about 7 minutes' time, we get a decision from the Bank of England, Tom, and it looks like a back-to-back interest rate increase, if the estimates are anything to go by.
John, you mentioned on the break here the growth rate of England. Review that for our American audience here. Is the United Kingdom growing?
The forecast from the Bank of England is 5% growth this year, Tom. It's pretty punchy. The forecast on the street has a four-handle. The survey of economists that we conduct. Whether that holds up, given what's happening with energy prices and higher interest rates, I think remains to be seen. The news this morning that the UK energy regulator lift the cap on energy costs for households in the UK, that's going to hurt a lot of low-income families. And the news that's dropping right now, Lisa, is that the Chancellor on the fiscal side of things is trying to do something to offset some of that pain.
Yeah, the idea that UK energy bills jumped by 54%, that's a pretty hard pill to swallow, and it really could potentially impact growth. I keep thinking about what Danny Blanchflower was basically saying, which is, what is a rate hike going to do in this mess, in this muddle of politics and energy prices? I don't know the answer to that, and basically each central bank is coming up with their own version of why rate hikes matter when we do not understand the inflation and we do not understand how much that'll dampen growth.
John, I'm on top of this story. I'm watching Bank of England on TikTok. It's very informative.
Is Governor Bailey on there, Tom?
Yeah,
Does he do a dance
really
before
good.
he hikes interest rates? Is that how that plays out? I'm pleased
they're
you're
showing the
engaged
bar.
and
They're
focused
showing,
this
John,
morning.
it's someplace you know well. They're showing the bar in the old Bank of England building.
That's a little bit away from the Bank of England. I know what you mean.
Thank you.
Towards Temple. Do you mean that one?
I if you say so.
I think you do.
Yeah.
Futures down 1%. I'll run it through the markets for you. On the Nasdaq 100, down a little more than 2 percentage points this morning. Into the bond market, yields at 177.70. Also need to talk about the ECB. Euro dollar negative 0.2%. Euro dollar Lisa 112.80.
We've been talking about how the upside surprise this year in terms of rate hiking expectations could come from the ECB. How do they really, to look at a 5.1% increase? I can tell that Tom really is on board with that kind of idea. At the same time, you know, we've been talking about the wage dynamic. It's just not there. I just keep coming back to sentiment. How much is basically central bank hiking, signaling to consumers that they're on it and trying to get some kind of tightening there?
Well, here's your update on Facebook too. It's negative 21.5%. There's a signal there, isn't there?
Yeah, it's a signal.
If you miss, you get absolutely punished. Amazon coming up after the close. Look out for that. Coming up shortly, Rob Davis, the president and CEO of Merck. Your Bank of England rate decision is just around the corner. From New York City, this is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a third dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
We came into the year pretty optimistic about the economy, about earnings, and that's still our view for February through December.
I think we'll look back on 2022 and say this was Europe's year.
In the second half of the year, the focus really will be on the ECB. How far can the ECB go?
I know it's a very popular narrative out there that the ECB has to act sooner and faster, just given some of the spot inflation numbers.
I think what all Christine Lagarde can do is to slow down the process.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Facebook getting absolutely hammered in the pre-market, taking down the Nasdaq by more than 2%. And TK, we need to talk about this Bank of England. They hiked 25. Some people on the MPC wanted even more than that.
For those in America, this is really, really important. It's off the radar. It's across the Atlantic. But, John, this links right into the Fed meeting in March.
4 dissenters, Lisa Abramowitz, voting for a 50 basis point.
Yeah.
They didn't get one.
No.
Let's be clear. But I'm not sure many people expected that this morning.
And there is this hawkish tilt with beginning the unwind of quantitative easing. That was a question of whether they would start to do that. Danny Blanchflower just saying that they should not do that, of course. One of the more dovish people we speak to right now, we are seeing a move that is pretty strong, though, in the UK 2-year yield as they climb to some of the highest levels in a long time. I just wonder what the goal is here, given that so much of this is from energy.
So beginning of the QE unwind, should we call this QT? On the corporate bond purchase program, they're looking to fully unwind all of that. There are votes out there for a 50 basis point hike. To be clear again, if you're just tuning in, they delivered a 25 basis point hike. You've got to imagine, Lisa, this ain't it. There's more to come. And when we got the last interest rate hike and it was just 15 basis points, I was just sitting there thinking, oh, it's 15 basis points. They're dipping their toe in. Let's see how far they take this. If you've got dissenters voting for 50 basis points, they're going again. They're going again.
And right now we're looking at 2-year yields, just to put a size and scope on this, in the United Kingdom, the highest going back to 2011. So at this point, you asked the great question, John, how much is this going to turn potential growth into a contraction at a time when people are going to change their spending behavior in the face of a more than 50% increase in energy bills?
It's absolutely fascinating, Tom. So on the same morning, we've got the energy regulator raising the energy cap. The Chancellor's trying to offset that. We've got a Bank of England raising interest rates by 25 basis points, and some people on that MPC, Tom, would like that interest rate 25 basis points higher than it is right now.
We're going to go to Peter Oppenheim here, John, but let me ask you as an arch watcher of this, and of course with the ECB coming up as well, is the Bank of England showing a certain courage where we see reticence at the American Fed?
So looking across the central bankers of recent years, Tom, Governor Bailey back to Governor Carney, back to Governor King. Governor Bailey does not want to hold your hand like Governor Carney did in markets. That's not a criticism of Governor Carney. Governor Bailey just seems to be communicating in a very, very different way.
Well
he
said.
just seems to be
John.
Getting it done, and getting it done sometimes when people don't expect, not getting it done when they do expect it. Peter Oppenheimer joins us now, Chief Global Equity Strategist at Goldman Sachs. Peter, can we sit on the UK just for a moment? It's a bizarre moment. The Chancellor's trying to offset the pain for energy prices. The Bank of England's whacking up interest rates by 25 basis points and maybe more down the road, Peter. What's your take on all of this?
Well, as you say, it's not an unexpected move, but it's a necessary move given the rise in inflation, both core and headline, and also the significant tightness in the labour market. And as you said, there are similarities here with the US, and so I think markets will be watching very closely what the reaction is in the market. But it is a difficult decision because while you're seeing these higher inflation pressures, at the same time the cost of living is going up. You've just seen a big rise in energy prices.
Peter, that's okay. You can put David on hold. Okay, you can put David on hold. It's not a big deal. Continue.
Well, thank you very much. I'll mention that. There's a squeeze in energy prices just coming through, and of course there's also an increase in national insurance taxes. So this will affect consumers as well. So it's a very difficult balance, but in the end, the economy is robust enough, I think, to withstand the effect of rising rates away from what really have been emergency levels. And I think, as you say, this really is a situation which all central banks are now facing. Is it still appropriate, given inflationary pressures, to keep interest rates at what were, after all, emergency levels in the face of the pandemic?
So we're at 50 basis points right now. Traders in the market, just in terms of market pricing, we're pulling forward the 1% line in the sand to May. Peter, just for people in the United States and outside of the UK, can you just walk us through on how important bank rate is at the Bank of England, how quickly things just kick in? They make a move and the banks follow almost immediately.
They do, absolutely. So, it will have effect on borrowing rates. Remember also that mortgage rates in the UK, while a large proportion are fixed, unusually relative to other countries. They don't tend to be fixed for very long periods of time. 2 to 5 years are quite common. And so you will gradually start to get this squeezing through into bank lending rates and to the broader economy.
Sterling 136.11 right now, a little bit of sterling strength this morning. Peter, we're so honored to have you here. Peter holds one of the most prestigious undergraduate degrees in the world with first-class honors, a geography degree at the London School of Economics. Peter, I want to go all Lionel Robbins on you. This moment seems like we did the pandemic and the financial bigwigs won and a lot of other people lost. How do central bankers across your geography, the ECB, the Bank of England, the Fed, and all the other central banks, how do they get us out of this, extract us out of these excesses and provide stability at the same time?
Well, I think that the first thing we should recognize is that the economies are recovering, and despite the obvious panic given the speed of the adjustment in rate expectations, we're looking at global growth this year to be about 4.3%. That's still about a percentage point higher than the long-term trend. So you have to think in the context of that, and facing some important inflationary pressures, that gradually increasing rates, at least to a level from which they could be cut again at some future point, does make some sense. I think that in some ways, the central banks would be quite happy with the reaction that we've seen so far. It hasn't been a panic. Remember, as recently as June of last year, the consensus was looking for no rate rises, for example, in the US this year, and perhaps one at the end of next year. We're now seeing a whole sequence of rate rises that have been priced in, and risk assets are holding up. There's nothing that's systemically problematic at the moment. So it's gradually weaning, I think, economies off of zero interest rates in a period of reasonable growth but higher inflation that I think makes sense, and we'll probably see more of it.
Peter, it makes sense, and the issue is how you trade around it, and you've been talking about the value trade, yet I'm struggling with financials at a time when each rate hike is met with more yield curve flattening, and we have seen it in the US, in the UK, and throughout the Euro region.
Yeah, firstly, I should say we have been recommending a focus on value. We think that in a more inflationary and a reasonable growth environment, many of these areas do look more attractive, particularly in the energy space. But we've liked banks as well. And you're right that a flattening yield curve is not ideal. On the other hand, any rise in rates, particularly across the European region, where they've been extraordinarily low, in the euro area still negative, would be quite helpful for the banks, so long as the economies remain robust. I think the time to be worrying about that sector is when you really would get a rollover in growth as a result of higher rates, and we're not in that phase yet. In fact, across Europe, we're quite optimistic of growth. We've got UK growth this year at around 4.5%. Compared to about 3.2 in the US. We're looking at over 4% growth in the Eurozone. So I think given that growth, the banks will still be able to absorb flatter yield curves in an environment where short rates are rising.
Peter, I would not mention individual securities, but you do mention Amazon in your research note as something beleaguered and downtrodden. What does Goldman Sachs say about Amazon this afternoon?
Well, I think I would want to make a distinction between, unprofitable tech companies, and we have a basket of those which have fallen very, very significantly as interest rate expectations have increased, and other growth areas of the market that are profitable with strong balance sheets and are cash generative and weren't that expensive to begin with. I can't comment on any particular company, but I think that we are starting to see some growth areas of the market also coming back to levels which look reasonably attractive given still quite solid fundamentals. So our view is that while we've liked value, we don't want to be only in value. There are certain areas of growth which make sense to mix with these deep value areas. And in that sense, I think this combination of factors will continue to dominate in a way that we didn't see in the last cycle, which was very, very much focused on just one factor, and that was growth alone.
Peter, you're a good man for just rolling with us with that Bank of England decision. Thank you, sir. I appreciate it. Come back soon and we'll talk more about equities. Peter Oppenheimer there of Goldman Sachs. That was not the 5-4 vote we were looking for. Let's be clear about that. 5 voting for a 25 basis point hike, 4 voting for 50.
Stunning.
Unreal.
Could you imagine that in America, John?
Not what I expected, and maybe people start to rethink that conversation, but let's not go there now. Cable 136.20 on sterling. And Tom, this got my attention too. Lizzie Burden and the team leading the coverage with David Goodman out of London. 7.25% is where they see inflation in spring for the Bank of England. And that prompted some of these officials, Tom, to go harder and vote for more.
Absolutely original, and of course this bodes well for our visit to London here coming up in the coming weeks as well. Team surveillance over in London as they open up and to see how that goes. Right now we digress and we mix part of this, the pandemic and the medicine, the miracle medicines that have helped all of us through the pandemic, and also look at the hard-nosed ability to run a pharmaceutical company. Rob Davis, with tenure at Baxter, is president and chief executive officer at Merck. It has been a tumultuous 12 months for Mr. Davis and the venerable company. This is a company with heritage back to the 17th century in Germany. And of course, I know it from the mumps and rubella miracle that Merck conceived in the 60s and the 70s with a wonderful Gordon Douglas. Rob Davis, thrilled to have you with us today. Here's the criticism. You guys missed the Pfizer-Moderna boat. Respond.
Well, I look at what the company has done, and I'm proud of our ability to contribute to the COVID-19 situation. This is an all-hands-on-deck situation. And obviously, we brought forward molnupiravir, which is an important antiviral drug to help in the fight against COVID-19. It reduces the risk of death by about 90%. So this is an important addition to the armamentarium. And really, as we think about battling COVID-19, this is an important drug. So we feel good about it. And this is about what do we all do to address this more than it is looking at comparison.
When you talk, I agree with you totally. When we talk to the medical experts, they are screaming for efficacious drugs for the poor, for those that can't take advantage of mRNA refrigeration or even the expense. How do you dovetail the Merck Research Combine with the ability to once and for all take care of COVID worldwide for the great number unvaccinated?
Well, and I think that's a great question and so important in how you can think about molnupiravir, our antiviral. This is a drug you take orally. It's obviously easy to supply, easy to get around the world. And one of the things I'm most proud about what we've done as a company is what I think a really creative and first of its kind access strategy to make sure we can get this to the parts of the country and around the world that need it. So I feel really good about what we're doing.
This is so important. What do you need from Joe Biden to affect this? What do you need from Washington to get your drug and the competition's drugs out to people in the Sahara?
Yeah, well, a lot of this it's not only about what we do with U.S. government, it's about how we partner around the world, like what we did with UNICEF recently. So this is a global effort, not just a U.S. effort. But I do think, importantly, we need to help people understand the efficacy of these drugs, the safety of these drugs, and get the message out about how you can get them. And that's really what we are trying to do, is make sure people understand how can they find them and how can they take them, because they do make a difference. If you look, we still have in the U.S. 2,000 people dying a day from COVID-19, and you have a drug in molnupiravir that reduces the risk of death 90%. We can make a difference. We just have to continue to get the message out there.
Rob, how difficult is it to determine how much to charge for this, given the public health need for it, and the fact that the U.S. government is really stomaching most of the bill?
Yeah, well, a lot of this, we look at what is both the value proposition we bring and the availability of the relative governments around the world to be able to give access to their own populations. And so we actually put in place a tiered pricing strategy aimed at what is the affordability based on economic conditions in the local market to make sure we can give access to the patients that need it, while ensuring we also continue to make the necessary returns to invest for the next innovation down the road.
There's been criticism around vaccines for influenza, for other viruses, as not being particularly profitable for a lot of companies. And yet here we are having this be one of the biggest health crises that we've seen in modern history. How do we sort of reframe how we think about vaccine development after it has not been a hot spot for a lot of companies over the years?
Well, I think what we just have to keep making sure everyone understands that vaccines in general are one of the greatest health contributions that have ever been made. If you look at the people and the lives that have been impacted by avoiding disease, it affects everyone in the United States, everyone around the world. We talked a little bit about MMR. You think about the number of childhood diseases, adult diseases we've avoided. So it starts with understanding the importance of this as part of driving for a healthy population, and then looking at what is the returns necessary to ensure that people continue to want to invest capital behind that. And that's what we're very much focused on.
Rob, cancer drugs cost $50,000. And of course, you guys, and I'm going to mention your good competition, Bristol Myers, are iconic in cancer treatments as well. Your pill for COVID has a treatment price of roughly $700. That is chump change compared to what it costs to hospitalize an unvaccinated person in America. Can you explain to our audience why Merck and Joe Biden can't get on the same page to take your drug and solve the unvaccinated problem?
Well, and I think, it is a matter of looking at partnering with U.S. government. The U.S. government is ordering. We've actually delivered already to the U.S. government. We're going to deliver about, in total, 3 million courses of the drug by roughly about actually the end of this week. So we are working with the government. They are supporting us. I think it's just about us collectively getting the message out there and ensuring that the drugs are in the locations where patients can get access to them. And that's where we're focusing our partnership with the U.S. government to try to drive that message.
Rob Davis, thank you, sir. Wonderful to have you on the program, the CEO of Merck. We need to talk about this market. Futures down by more than 2%. Sterling breaking out. Gilt yields breaking out too. Just an unreal move. This was not the 5-4 vote that anyone was looking for. Tom Keene, Catherine Mann, good friend of this program, voting for a 50 basis point hike with 3 others. They go with 25. Well, it could have been more, Tom. This is just not part of the conversation coming into this. And the conclusion for me, we are leaving behind the era of hand-holding and warm, fuzzy guidance from central banks. And Governor Bailey is leading the effort.
There may be some of the MIT reality from Dr. Mann. I mean, she's been a realist in her economics and in her research, John, from day one. Her ownership of the dysfunction between China and America, just as one example. John, I need you to reframe here why this meeting is so anti-David Blanchflower.
Well, Danny didn't want to hike full stop, Tom. And they've gone 25 and could have gone a whole lot more. They're unwinding the QE program. Danny wanted to see that. That's what's happening. I just wonder if this starts to bleed into the conversation around the Federal Reserve. And I would caution anyone that starts to do that for the following reason. The Federal Reserve has come out with a lot of communication over the last few weeks and really played down the 50 basis point hike. Lisa, that might change after the next CPI print. So what I'm saying now might be dated in a month or so. So if things change, things change. For the moment, they're pouring cold water on the 50 basis point hike. The Bank of England, there's hardly been any guidance whatsoever since they last hiked interest rates.
Okay, yes. However, you do wonder if perhaps the Federal Reserve officials have been looking at inflation, forward guidance on inflation that looks different or is nuanced from what we are and sees more rapid increases. And I do wonder whether a disappointing print on the labor market report that we get tomorrow actually indicates a tighter labor market, a lack of workers, and wages that are going up faster.
So we'll see. And then it's on to the CPI print next week. We'll get another CPI print before the next meeting. To Patrick Harker at the Philly Fed, he said the inflation data matters, and if that changes, he might change his view on a 50 basis point hike. So let's wait for the data on that front. For the UK, Tom, for the UK, I think now just the conclusion is they'll go again, and perhaps they'll go again. And that's why we're bringing in that 1% line in the sand all the way into spring, early summer.
I think it's something that global Wall Street understands. These are two stunningly different economies, John. I really take issue with the linkage of Bank of England over to the Fed. These are two hugely different structured economies. And for that matter, John, can we posit now that the U.S. and the ECB and the greater European continent maybe have more in common than an island nation, you know, the stereotypes that we all have about the United Kingdom?
You might make that argument around the economy, Tom, and I won't get into that now. As far as the central banks are concerned, the Fed's going to get going soon. The ECB meeting a little bit later, that decision in 25 minutes, they're trying to push this conversation off into the distance.
How can they do that?
How sustainable is that effort? I've got no idea, Tom, but the Federal Reserve is going to follow where the Bank of England is going at the moment.
John, I just think it says, you know, road trip. We need to
I
be
thought
one week in London and, you know,
catch up with Governor Bailey.
Francine was in Rome. I can see us in Rome.
Tom, let's be clear. The announcements here this morning are going to hurt a lot of people. That increase in the energy cap for low-income households, that will hurt. For anyone on a so-called variable rate mortgage in the UK, the next month, this is going to kick in almost immediately. 50 basis points up just like that. So many of the loans in the UK are benchmarked to bank rate at the Bank of England. That was something that Governor Carney was very sensitive to over his tenure. It's very different, Tom, just in terms of the translation of rates in the US.
Is there a linkage there of the Bank of England to the politics we see in the green-leathered House of Commons like there is in the United States?
Well, certainly I think the Chancellor feels the cost of living crisis, Tom, in a big way. And isn't it somewhat confusing that when we talk about the GDP forecasts of 4-5% for the UK economy coming into 2022, that we don't have the feeling that things are good? And it's because inflation is where it is. And they're forecasting at the Bank of England, Tom, inflation north of 7% in spring. And I think that's what spooked a lot of people on this MPC today.
And I give Lisa credit for this, folks, in that really emphasizing years ago the gains of this pandemic stimulus, how much of it, John, has gone to the elites, to the haves, where so many other people are struggling, and that's a battle all these bankers have.
If you've been long the market, it's felt good. And Lisa, if you look at consumer sentiment, clearly, for a lot of people, things don't feel good at all.
And this really is illustrated by the real wage picture, which is the most negative that it's been a very long time. And if you have people that feel less good at a time when their dollar goes less far, their guilt goes less far, how do you then parlay that into growth rather than a disinflation or deflationary environment?
So we turn now to Danny Blanchflower. Is Danny with us, Tom? We got Danny with us?
He is.
I think we do. Danny, great to have you with us, sir.
Thank you.
Let's get your response to this, please.
Well, I think it's more confusion. A vote of 5-4 with 4 people voting for a 50 basis point rise, and then you sit and start to read the report, and it's like out of dream world. I mean, it talks a lot about the economy being at full employment, but I was just looking, I just tweeted out the employment to population rate is over a full percentage point below where it was at the start of the pandemic. Employment is down 400,000. The employment to population rate down, labor force participation rates down. Wage growth has slowed dramatically every month in the last 6. And this forecast basically says, yeah, inflation's coming, but there's a strong forecast of unemployment rising in the UK economy as a result of this. So I think back to the story of your mum. The inflation, I mean, energy prices are going to rise, but this is going to slow the economy more on top of the fact that it was slowing to start with. So I think this is really pretty interesting, and it does certainly signal that there's more rate rises coming, but it's extremely incoherent, I would say. I mean, especially given the lack of communication over the last 2 meetings. So confusion reigns. I mean, I just don't believe the forecast. I don't believe one of the big things I was looking at a minute ago is they're forecasting a rise in wage growth, despite the fact for the last 6 months, every month, wage growth has been plummeting. So I think this is a world of guessonomics, and they will live to regret this decision to their dying days.
Well, let's talk about consequences, and that's a pretty stern line to finish on there, Danny. So I'll talk about market pricing, and you tell me what the consequences are and why they're going to live to regret it. The team here at Bloomberg tracking a market pricing, Bank of England rate hitting 1.5% in September. What's amazing about this is they didn't see it getting there until 2023 before the decision today. So that's been brought all the way back in. So the consequences of getting to 150, Danny, with inflation accelerating and not dying down, what are the consequences then? If you think they're truly going to regret this decision, how bad do you think it will be?
Well, I do think they are. I mean, in a sense, the way you read it, I mean, I think what you said is completely right. And you read it with a sort of degree of certainty. When you read these things like, this is what's going to happen within all the error bands. So I think the reality is they simply don't know. They simply don't know the extent to which inflation is just going to fall. They don't know how the virus is going to proceed. They don't know what long-run changes in behavior are going to be. I mean, with this inflation moving, presumably people are going to stop spending. I mean, this is going to slow the economy. So much of what they've talked about is data dependent, but they don't seem to have actually noticed that the economy is slowing fast. It's the 4th fastest growing economy in the G7, the 4th fastest. So this is the first place to raise rates. They also, John, they talk about they're going to stop reinvesting maturing assets. This is really a signal of a very significant tightening. The prospect of what you've just talked about happening by the end of the year is essentially nil.
If you're just joining us on Bloomberg Radio, Bloomberg Television, David Blanchflower of Dartmouth College is with us, Rauner professor at Dartmouth, of course, former member of the Bank of England. For those of you in America, a profound decision by the Bank of England. They do what's been talked about in America, but what we've not seen from the Fed was significant tone of higher rates, sterling at a 136 level. Professor Blanchflower, Kit Jukes at SocGen, with a brilliant short note today, says, look, here's the reality. The 5-year forward swap, the measurement of inflation out there is already trending down. Is that what you see in your data, that the central banks are affecting policy for yesterday maybe for today, and you disagree with Dudley, they're fighting the wrong battle out into the future?
Well, I do think so, Tom. I mean, the question in a sense is, what is there to suggest that the pricing increases we saw over the last 12 months, a lot of it driven by supply-side events, will repeat themselves in 2022? And I see every likelihood, especially based on the note that you just said, that actually we're going to see a slowing of inflation naturally coming. I mean, people stop buying highly priced goods. I look back, I was just looking back now to the data for 2008. This is almost exactly the mood music. In August, September 2008, inflation was above 5%. And what happened? 12 months later, inflation in the UK was at 1%. If you look at the data on inflation, it spikes. What goes up does come down, and there's nothing to suggest that fundamentally workers' bargaining power has suddenly increased, and this is all going to get sustained. So I agree. Wrong war, fighting something that happened a year ago, and we're going to see inflation plummet like a stone.
A lot of people disagree with you, and I'm going to steal from Stan Fisher here. The basic idea is we're wicked accommodative right now. And all they want to do, a la Bailey today, is get back to some form of neutrality and not restriction. Is your reading of history they can be successful at managing this to neutrality rather than overshoot to restriction?
Tom, how can you get back to normality when the world you're in is an unusual one? In 2008, you were hit by a giant financial crisis shock, which was a downward hit to the economy. What you've seen today in the last 2 years is a huge hit to the economy from the coronavirus, which is still impacting people's behavior. It's still impacting whether they'll go to the cinema, whether they'll go on a cruise, whether they'll take an aeroplane. This thing isn't over. So to say you can go back to normal when the world isn't normal, this is in Gaga land. It's like, pretend everything's back to normal. We want to go back to normal, even though it isn't. So
Danny,
I think that's the logic.
There are some real consequences, though, for the Bank of England making this move. I'm looking right now at the pound versus the euro, and it's the strongest right now going back to 2016, which ultimately should help them bring inflation down, should help it drop like a stone, like you said, which on a net basis should be terrific for the end consumer, for especially low-income individuals who are actually going to have more spending power as a result. Why is that a bad thing?
Yeah, but the consequences of slowing inflation is that you slow output. And so the forecast is talking about a rise in unemployment. And all the research we have from around the world, let's just get real about this. A 1 percentage point rise in inflation hurts people. A 1 percentage point rise in unemployment, which is essentially what they're trying to generate, and there's a new paper out in the last few months, shows that that's 10 times worse for pain, 5 times worse for well-being. So it's not as if the alternative to pain from inflation is everything is wonderful. What you do is you say, we'll take the pain from inflation away, we'll help people who've got bets on what will happen to interest rates, and what we'll do is we'll make matters much worse. So we're going to generate slowing of output, rising unemployment, and we know, just to make sure that people understand it, that rises in unemployment, slowing in activity, hurt people much more, and especially the people at the low end. So this is a really big problem, as well as the fact that now in the UK, tax rises are coming, which will also hurt people more, and they've cut benefits at the low end. So actually, this is there's a heads you win, tails you lose worse.
Danny, looking forward, is what you're saying basically that at this point, the Fed, the Bank of England, the ECB don't have the power to really affect the inflation that we're seeing and the impact that it's going to have on growth?
Well, Claudia Salmon said this all along. She says what we need for central banks, the reality for central banks is we need to solve the problem of the virus. This is a COVID-driven world. There are supply chain problems. So if the central bank could sort of open a new Long Beach port and solve those supply problems, that would be fine. But this is not a traditional inflation situation where there's too much demand in the economy. This is a supply-driven situation. We need to get to grips with the COVID pandemic. And for central banks to say, we'd love to get back to normal. Well, absolutely, we'd love to get back to normal. We'd love the COVID virus to disappear. But, I mean, to argue that we're going to go back to normal and we can ignore it because we know what's coming makes absolutely no sense. And, of course, the credibility of the MPC has been completely trashed over the last 3 months. It's quite clear they have no idea what they're doing.
What's amazing about this moment, though, Danny, as you know, is that there's someone out there, many people out there that take completely the different view on this situation. And Danny, that's what's fascinating.
But they've been wrong for the last
about
decade, so They've been wrong
think
for
this
the
is
last
a
decade, and they're
different
wrong again.
moment, Danny. They think this is a different moment to the one we were in 10 years ago. Why don't you?
Well, I do think it's a different moment. I think it absolutely is a different moment, but it's comparable. It's comparable, and the big thing is in both situations, everything that happened from 1945 to 2007 was essentially irrelevant. The ability to forecast what you would do based upon those situations was, I mean, what we've learned was that you couldn't forecast that. You had to look back probably at the 1930s. And maybe what we do with this pandemic is we look, I mean, John M. Barry wrote, I think this week in the Washington Post, said, look back to what happened in 1918. This thing isn't over. There are complete economic consequences of the pandemic in 1920, just as there are now. And the central bank in the UK's case is behaving as if it has prior data that it can forecast on, and it knows what's coming. It's as if it knows what long-run changes in behavior there will be. And it doesn't. This is a world of great uncertainty, and you proceed forward saying you know what's coming at your peril. And that's what we learned in 2008, 9, 10, and that's what we should be doing now. I'm not saying I know the answer. I'm simply saying that those who say they do know the answer simply do not.
Well, Danny, we appreciate your opinion, as always, buddy. Twice in the morning. Thank you very much. Danny Blanchflower there of Dartmouth. For the first time in 17 years, back-to-back interest rate increases from the Bank of England. The governor on Threadneedle Street raising interest rates 25 basis points. The vote, 5-4. The 4 wanted 50 basis point hikes. The 4 included Catherine Mann, formerly of Citigroup, Tom, a good friend of this programme over the years as well. The forecasts of the Bank of England now look like this. Inflation peaking at around 7.25% in April. It had been expected to peak at about 6%, so inflation higher than expected. That has clearly spooked some people on the Monetary Policy Setting Committee over at the Bank of England. Growth, Tom, set to slow. We talked about a 5 handle. We're now staring down the barrel of 3. The prospect of higher unemployment as well, and this is where things really start to get tricky. Right. Pick your poison, TK. Which one is it right now if you're a central banker?
Governor Bailey with a headline out of comments here on this historic morning. He says Omicron impact likely limited and short-lived. John, can the United Kingdom open up as New Zealand's talking about opening up? How open is Britain right now?
The UK, different. They're ready to go, Tom. They're ready to move on. They're moving on, and they're moving on quickly. And clearly the governor is as well. There will be some complaints about guidance today. Why were people surprised by this? Why didn't we get a speech from Catherine Mann talking about maybe doing 50 basis points? From the communication we've had from this Bank of England over the last several months, it's clear to them, Tom, that this is a feature and not a bug. They don't want to hold your hand anymore, and I've been saying that repeatedly, and there's no other conclusion, is there? When you get 4 people on a committee voting for 50, and there's a feel in the market that has come from nowhere.
John, let's color for our audience, particularly in America, who this guy is. I had the honor of sitting with Governor Bailey just before he was selected on our set at that desk in London. And John, who is Mr. Bailey?
I think for many people, Tom, they remember him as the chief of the Financial Conduct Authority. I think for a lot of people in the UK, they wanted to move on from the superstar central bank governor that was Governor Carney and just get back down to basics. And you might be surprised by that, you might be upset by it, but ultimately you've got to deal with what you've got. And what we've got right now is a central bank governor that doesn't want to give you a warm hug in the City of London and tell you everything's going to be okay. And this is what I'm going to do tomorrow. He wants to turn around and just get it done. And Tom, has clearly taken some people by surprise. But by the way, that's been repeatedly in the US when it comes to this central bank. There is no defined path this time around. The central bank governors and presidents and chiefs and chairs, Lisa, they're going to have to do things differently. They're going to have to be much more nimble. And in the short term, maybe in the medium term too, but in the short term, that's where things get messy.
And it gets messy because the longer that inflation runs at these types of rates, the more it may crimp demand, the more it may crimp consumer spending. And they're trying to accelerate the cycle, lengthen the cycle, not necessarily curtail it. It's such a confusing moment on all sides of the Atlantic.
Futures look like this morning then. If you're just tuning in, we're down by more than 2% on the NASDAQ. Facebook has a very large weighting on the NASDAQ 100. 5% of it, it's down hard. Kaylee will run you through that in a moment. That's weighing on the NASDAQ, on the S&P. We're down about 1%. If you switch up the board, let's take a sneak peek of what's happening elsewhere. On Treasuries, on 2s, 10s, and 30s. A lift to the front end on 2s in the US, up a basis point. I can tell you in the UK, up a whole lot more. We'll touch on that a little bit later. Switch up the board again, and let's finish on this just briefly. Let's have a little look at what's happening with Euro Sterling. 83 pence.
Oh, look at that.
Euro Sterling negative 1/3 of 1%. That's a stronger pound TK, it's over to you, President Lagarde, in about 10 minutes' time.
It'll be interesting to see with Christine Lagarde, and you wonder if she will actually comment directly on what the Bank of England did. That will be interesting, John.
The ECB decision in 10 minutes, and then on to a news conference 45 minutes after that. Should we get you some single names, some movers?
Please.
There is only one this morning. Let's get to Kaylee Lyons. Hey, Kaylee.
There is only one indeed. What was a $900 billion company as of yesterday's close could be more like a $700 billion company come the opening bell in about 2 hours' time. Meta Platforms absolutely cratering in pre-market trading, down 22%. You had Facebook user growth stagnating for the first time ever, disappointing revenue forecast, taking a hit from those Apple rule changes, and of course, Tom Keene and everybody else is using TikTok a little bit more. That is all dragging hard on Meta, but really social media stocks across the board. Snap reports after the bell today. Twitter next week, they are down 15.4 and 7.2% respectively in pre-market trading. Speaking of users and subscribers, that too is an issue for Spotify. It is no longer just about all that Joe Rogan drama. Its guidance really disappointing. That stock is down about 10% after its report yesterday. Qualcomm also on the back foot a little bit here. It did beat on the top and bottom line. Chip sales to smartphone makers are doing well, but the shortages are meaning it can't expand its business into other areas like in cars or the Internet of Things. So that stock taking a small leg lower, down less than 1% though. And then of course it all tees up toward Amazon after the bell today, Tom. That sentiment not great going into that print. That stock is down about 3.6% in early hours.
And of course, part of that advertising, as we saw with the Google spectacular results of, seems like ages ago, a few days ago as well. On Bloomberg Radio, on Bloomberg Television, this is Surveillance This Morning. John Farrow, Lisa Bramowitz, and myself, and we're thrilled to give you voices that are expert on the culture of central banks, the political challenges of the continent of Europe. We welcome Holger Schmieding. He is chief economist at Berenberg. Just a perfect time to speak to him as we spoke to Professor Blanche Flower moments ago. Each of these banks is culturally different, Holger. For our American audience, explain the political terrain that Christine Lagarde has to traipse here from Finland, from Sweden, from the continent, central countries, down to the Germanic fear of rising inflation.
Yes, indeed, the Eurozone is different. These separate nations that share a currency make for a different political mix. There are some that usually prefer lower interest rates. There are some that usually prefer higher interest rates. There are some, like the Germans, which for historic reasons are very afraid of inflation. There are others which think that a little bit of extra inflation would not be bad. So there is a different angle. We have similar debates in other central banks, but the different angle in the Eurozone is that this is a collection of individual nations. So this is not a debate within one nation. But it comes with one advantage for the European Central Bank, because the European Central Bank does not face one parliament, does not face one finance minister, but has 19 finance ministers. It means that the central bank does not have to listen to any individual finance minister, any individual government that much. It just has to feel around how the overall political mood is as a backdrop to what it's discussing.
When you sum your work with Dr. Levy, Mickey Levy, doing Berenberg work in the United States, how far behind is the ECB?
The ECB is not yet behind the curve, but is at risk of falling behind the curve if they stick to their previous guidance, namely that a rate hike this year is, quote, very unlikely, unquote. Inflation in the Eurozone is high, but so far it is driven only by these supply factors. It is not yet driven by excess demand. It's not yet driven by excess wage pressures, two factors which are there in the US. But beyond the Omicron wave, the outlook for growth is strong. So demand will play an increasing role in the inflation outlook, and the ECB should better see to it that it does not start to follow the Fed in falling behind the curve.
Holger, there's a school of thought that the Federal Reserve, the Bank of England, the ECB should not necessarily raise rates to slow the economy because it will naturally slow, but that they should raise rates to prolong the cycle, that otherwise the slowdown would be much sharper as consumer spending gets really hit by inflationary pressures and a loss in real income. How much do you buy into this argument that actually hiking rates and curtailing some of the inflation could lengthen the cycle and give more headroom to the central banks?
Well, I rephrase that a little, but sorry, yes, what will happen is that if you raise rates, you will have a dampening impact on consumer spending. The economy will be less hot. And if the economy is less hot, then of course you have less of a boom-bust risk. You do lengthen the cycle. So indeed, central bank early reactions can help to prevent the overheating, the boom, which would then have to be followed by even worse rate hikes and a bust. So once again, in this sense, it does make sense to smooth the cycle by leaning early against what otherwise would be excessive demand.
Holger, how much is the foreign exchange component something that the ECB has to address? That the longer they wait, the more the euro will decline, will depreciate, and this will actually increase the inflationary pressures as other regions hike. How much does this have to come into their calculus?
Of course, this comes into their calculus, but it's not the major thing. The major thing is simply, at the moment, the geopolitical risk for the near-term inflation outlook, what happens to energy prices in the situation around Russia's President Putin. We have the Omicron wave of infections still. We have the supply shortages. And all of these factors are probably on their own more important than the exchange rate. So the exchange rate plays a role, but I don't think it's the decisive factor in the ECB's discussion.
Holger, there's some, and particularly the cautious, who say, forget the inflation panic, who say there are indications of inflation ebbing, inflation rolling over, maybe just at the first or second derivative. What do you see in Europe?
Well, if it weren't for the spike in natural gas prices, again, think Putin, and for the recent surge in oil prices, inflation would probably have already rolled over. But rolling over is not the right way to look at it. If you start with inflation 5% in the Eurozone, 7% in the US, it's not good enough to have it roll over. The question is, does it settle back at 2% or at a higher level? So just rolling over doesn't suffice to say central banks could stay on hold. You would have to make an argument that inflation would fall too much, that is below the 2% target, if the rate hikes are implemented. And with all due respect to your previous guest, Mr. Blanchflower, I didn't quite hear him make that point convincingly enough for me.
We should have put you on a panel. Let's be clear about that. Holger, thank you.
That would be interesting, indeed.
I believe it would be very interesting. Holger's meeting there of Berenberg. Governor Bailey just wrapping up his news conference in the opening statements, Tom, the Q&A just starting, saying there's much uncertainty on the outlook. It would be a mistake to assume rates are on the inevitable long march higher. All this uncertainty, he points out, as we know, Tom, this is not a standard demand-driven rise in bank rate. The economy's not exactly roaring away, is it?
Well, he mentions the pandemic, and I'm going to say this again, John. The overlay here, including the fiscal pop in the United States, which I would suggest is discrete to the United States, and this is an unusual time. None of this is in the textbooks, and these are smart people, including Holger Schmieding, and they're making it up as they go. David Blanchflower, Holger Schmieding, good Mr. Bailey, they're all making it up as they go.
For Bloomberg Terminal subscribers, if you want to follow Governor Bailey in the Q&A part of the conversation in the news conference, you can do that on Live Go on the Bloomberg Terminal. We're waiting now 30 seconds away, Lisa, 35 seconds away from an ECB decision out of Frankfurt, Germany.
The pressure is on, especially as you see that incredible divergence right now between the Bank of England, the Fed, and then the ECB, the lone doves hanging out there and saying they don't need to act. They can remain at zero or below, and they can remain with their incredibly accommodative policies. I feel like the political pressure is getting harder for Christine Lagarde to stomach.
I want to repeat that line that I mentioned from Governor Bailey just moments ago as it goes red on the Bloomberg Terminal. A mistake to assume that Bank of England rates are on the inevitable long march higher. This is why it's so much harder this time around, Tom, to gauge what the tightening cycle from any central bank at the moment is going to look like, whether it's the Bank of England or the Federal Reserve. They need to be and want to be incredibly flexible, and that's why you get these surprises. No surprise from the ECB right now. Rates unchanged at negative 50 basis points, the main refinancing rate at 0%, to conduct APP at a pace of 40 billion euros a month in the second quarter, a pace of 30 billion a month in the third quarter as just they wind that down. Lisa, and confirm those December decisions out of the ECB this morning?
We never expected to see a rate hike. The expectation is that it's really going to be the press conference at 8:30 a.m. Eastern time with Christine Lagarde that will be the most interesting. How will she address forward guidance? What will her parameters of risk be? How will she gauge the fact that the Bank of England is coming out and saying that they're concerned that without tightening policy, they will not get back down to that inflation rate that they are looking for? How can she then come out and say, we're not worried?
If you don't like the T word, cover your ears, Tom.
Yes.
Inflation may moderately exceed the goal for a transitory period.
There it is.
The message
The
coming out
T-word
of the
launches
ECB.
in. John, I'm looking at this one headline, and this is, folks, this is a separation here. And, you know, in America, if you're going, why are we doing this? This is truly original. John, must see 2% inflation well before end of forecast horizon. I'm thinking 2030. What are you thinking?
I'm thinking maybe the same, given their inflation forecast right now. But their inflation forecast coming into today, 320 for 2022. CPI 180, 1.8 in 2023. I'm actually trying to follow two news conferences at the moment. I've got Governor Bailey on the one screen, and I'm looking at this ECB decision on the other. Manus Cranny can dedicate himself to one. He joins us now. Let's talk about it, Manus. What's happening in Frankfurt, Germany?
Jonathan, well, we're going to hear what her rhetoric is, because her objective, Christine Lagarde, Madame Lagarde, is, of course, to regrasp the narrative, to regrasp the agenda, and to push back against the 2 rate hikes that are already priced into this market. 2-year paper has moved by 18 basis points since the FOMC. So the short-end traders here are pushing. They've pushed to the point of where they see a rate hike in July. I think what's interesting is about when it comes to the asset purchase line, even though all three of you seem to be sort of slowly sleeping through this, is that the asset purchases, this is important, is going to be 40 billion in the second quarter. So as the pandemic, the emergency PPP rolls off, asset purchase program is the underbelly. But she must convey patience and not panic. That's the objective today. It may be accelerated inflation, but it's not enduring.
Manus, this is going to be the conversation in the news conference, isn't it? Can they sit out the rate hiking cycle of the Federal Reserve at the Bank of England? Why is it different for them? When the Bank of England's making a move, making another move, the Federal Reserve's about to do the same thing in March. What's different for them, Manus?
Well, Jonathan, our inflation, it's not like your inflation. That's pretty much what everybody will come on your show and say. I'm being slightly tongue-in-cheek. Unemployment here is low, but the wage negotiation here in the heart of Europe with the unions around me is very, very different. It's not like America. So the wage and the power of the wage negotiation here is something very different. It's a structurally different employment market. And that's maybe what gives them a little bit of room to breathe. Not much. I would say they're getting more and more boxed in. So I think in the autumn she said she wasn't for tapering. This woman is most unlikely to indicate that she's ready for tightening.
Manus, it's been too long, buddy. You enjoy the Euro tour. We'll catch up a little bit later this morning. Don't fall asleep in that news conference. I think this time around it might be a little bit more interesting. Don't you, Lisa?
Yes, I think
that
it's not going to be a snooze fest. I'm just going to say that right now. I'm sure that they'll be very happy with us.
Alberto Gallo joins us, the head of global credit strategies at Algebris. Alberto, the Bank of England on the one side, the ECB on the other, the Federal Reserve somewhere in Camp BOE. Alberto, get me up to speed on what you're looking at this morning.
There's a lot of questions for Madame Lagarde. First is if we have reached the right inflation level to be ready for a liftoff. And the ECB has been trying to dig their heels into a dovish policy. We know that Europe needs low yields because of the recovery fund and government spending and trying to lift economies from still high unemployment. We also know that inflation in Europe is different because there's a lot more transitory energy components and wages are still stagnant. Nevertheless, there is over one hike priced in for 2022, for this year. So Madame Lagarde will have to be really, really credible in pushing back. And we think markets will fight it because, yes, there are transitory components in inflation, in the Eurozone inflation, but the headline number over 5% is still very high, and keeping rates at minus 0.5% is probably still having too much weight on the accelerator. And we know what happens. If the ECB won't hike this year, still our base case, they'll have to do a lot more later on. The risk when you break very quickly as the passenger goes out of the windshield. So we're probably going to have a lot of dovish talk, but eventually they'll have to do more next year.
Alberto Gallo, you at Algebris are expert at gaming the x-axis to make profit. The common theme here of the central banks of the United States, of Britain, and in Frankfurt is trying to game the x-axis. Governor Bailey just talks about the long march. Are we rushing things here? Do you at Algebris think all of this is going to take longer than anyone can perceive?
So inflation, we think, is persistent. We're seeing expectations very sticky in the US and the UK. The UK also has bottlenecks that are structural because of Brexit. So we've been talking about persistent inflation when everyone was on the transitory account. Now, perhaps the question is, have people's expectations on rate hikes gone too far? Is there a competition to call for 5, 6, 7 Fed hikes, and how much can the economy really take? We think a front-loaded hike cycle is what we're going to see. So, more hikes in 2022, perhaps a little bit less in 2023. And that's also the playbook for the Bank of England. Hiking being front-loaded, but also probably not a very high terminal rate because economies still have a lot of leverage. Now, the ECB is going the other way around. They are delaying because wages are still stagnant, unemployment is still very high. And so they're going to have to do more next year. So probably, with the ECB, still probably no hike this year, even though the market prices one, but it means probably 2 or more next year.
Alberto, how do you position for this? How do you take advantage of the necessary ensuing volatility that we have seen?
So first of all, unfortunately, in this environment, we're in a hawkish cycle. We're in a bear market for risk assets. So if you're holding a long-only portfolio, which we're not, fortunately, especially if you're in bonds on a long-only basis, you have 2 outcomes. Either you lose money quickly because yields reprice, or you lose money slowly because you get your gains from coupons get eroded by inflation. So it's a very challenging market for being long bonds. So what we do is we play defense in bonds. We hide into credits that have high coupons, low duration, particularly the reopening sectors in the economy. And then we have a number of shorts because when the Fed hikes, there's going to be accidents. Where are the accidents? Probably in some emerging market countries that have unsustainable debt. Think about Turkey, for example. They've been defending their currency by increasing their balance sheets. Countries with weaker fundamentals, structurally, South Africa, very low spreads. So, we have a lot of protection for a hawkish cycle and accidents along the way. And we think that, as the dollar strengthens, these countries will have issues. And also weak credits across the high yield space. So it's a lot more nimble, lower gross, and lower beta portfolios for the coming quarters with a lot more liquidity.
Alberto, thank you, sir. Alberto Gallo there of Algebris on central banking and on the market with a pretty dark call on risk assets there. 2 pieces of controversy in the last 30 minutes for central banks. Governor Bailey saying this: the living cost crisis would be worse without the rate hike. That coming from Governor Bailey. Tom, the living cost crisis would be worse without the rate hike. That's his argument. The other piece of controversy for me as well this morning, Tom, is that the Bank of England clearly does not think this is transitory. The Federal Reserve is not using the T word anymore. The ECB is. They're sticking with it. And that's going to be at the epicenter of the conversation with President Lagarde at 8:30 Eastern in 36 minutes.
John, this is original economics. Everybody's thinking as hard as they can, and all you're going to do is look at the data. I'm going to go back to Kit Jukes, and folks, I'm going to make this clear. It is ever so slight, but the 5-year view out 5 years shows an ebbing of the belief in inflation. And as David Blanchflower mentioned, John, the big bet for those saying calm down, including Professor Blanchflower, is that goods inflation will come in. It's different in Europe, England, in America, but that's the core theme. The goods inflation will come back to some form of normality.
A ton of news out there today. This statement just came through from the President, Joe Biden, here in the United States. I'll read it out. Last night at my direction, U.S. military forces in northwest Syria successfully undertook a counterterrorism operation to protect the American people and our allies and make the world a safer place. Thanks to this skill and bravery of our armed forces, we have taken off the battlefield the leader of ISIS. All Americans have returned safely from from the operation. I will deliver remarks to the American people later this morning, Tom. He finishes with, may God protect our troops.
The second leader of ISIS, the Islamic State, you can call it whatever you want. And John, what I would suggest, just in a quick view here, is all of this has a massive recency. This guy was only really identified less than 2 years ago. So I would suggest to go after him in Syria has been a short order. It's happened rather quickly.
It is tough to get up to speed with what's happening this morning. We need to talk about Facebook too. Facebook is getting hammered in the pre-market. We are down, we're lower, we're down by more than 20%. On the S&P 500, we're down 9/10. On the Nasdaq 100, down by 2 percentage points. Mike Wilson of Morgan Stanley on this equity market joins us next on TV and radio. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
It's a dance between the Fed and markets.
The good news is that markets have been aggressively repricing future tighter money supply and tighter Fed policy.
This isn't one of those moments where there's so much uncertainty.
The Fed wants to sort of get out in control of the narrative.
It's a dynamic economy. It's not linear. These are not linear decisions.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. An historic day for economics, indeed, an historic day for the markets. Mike Wilson will join us with caution on the equity markets in moments. But John Farrow, the swirl that Mr. Wilson has to take in, including history at the Bank of England.
Where do you want to begin? It's been 17 years since we had back-to-back rate hikes at the Bank of England. We got one on Threadneedle Street, 15 basis points last month, 25 basis points this morning. It could have been 50. That was not the 5-4 vote. We were looking for 4 members of the MPC looking for a 50 basis point hike at the Bank of England. And Governor Bailey saying something, Tom, which I think is going to be controversial. The living cost crisis would be worse without rate hikes. That's what spooked them. Inflation is higher than expected. It could peak north of 7 in the UK at some time in spring. That's where they want to move. Others, Danny Blanchard at Dartmouth, Tom, he's taking completely the opposite view on things.
Yes.
He thinks you're hurting people more by making an interest rate move now.
Lagarde in 30 minutes in Frankfurt. Armanis Cranny will monitor that press conference. You'll see it on Bloomberg Radio, on Bloomberg Television, and hear it, I should say, as well. And John, what's so important, you mentioned this 20 minutes ago, you go from what the Fed is doing, including the testimony today, to the long march, maybe not in the Bank of England, to the dreaded word transitory in Frankfurt.
The T word, Tom. The Bank of England's ready to go. They're moving. The Federal Reserve's going to go next. Okay. The ECB thinks it's transitory still. What's the difference between the Eurozone, its inflation dynamic, the Bank of England, its inflation dynamic, the Federal Reserve, its inflation dynamic? In a word, Italy. The ECB has some different things to worry about.
We're not going to artichokes today.
When it comes to European markets, Tom, we're not.
Okay.
We're going to talk about BTPs, and you can't eat those.
Yeah.
That's the problem for the ECB, and that's been the problem for the asset purchase program, and that'll be the issue as they try and move away from very, very loose monetary policy.
Italy is a thermostat for England, for Europe, I should say. Lisa, I look at this, and what's so non-transitory is the politics. The president will visit New York City today on domestic matters, including crime. We saw on Fifth Avenue yesterday the services for a police officer here in New York dead in the line of duty. And, I look, Lisa, at all that's going on that economics, finance, investment is buttressed up against, and it speaks volumes about the haves and the have-nots.
Yeah, and inflation, really one of the polarizing debates right now. And really, to Governor Bailey's point, there is a huge divergence between the analysts who look at rate hikes as tools to prolong the cycle versus tools to cut off the cycle. And there is a small distinction here that is vast when it comes to whether people are arguing for a tightening cycle or not at this inflationary moment.
Through the data quickly to get to Mike Wilson. John, Facebook down.
And futures down with it. NASDAQ futures negative 2.1% on the S&P 500, down by 1 full percentage point. Yields are higher, breaking back towards 180 on 10s at 179.66. That's the Treasury market, Tom. I can tell you in the gilt market, yields are much higher, particularly at the front end of the UK. A 2-year gilt yield right now up 9 basis points to 1.1%. 12 months ago, in negative territory.
It will be interesting to see. With short introduction, Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. He is cautious on the equity market. Mike Wilson, your Ellen Zentner has a negative 215,000 statistics for the jobs report. Maybe it's a one-off, maybe it's not. Fold in this American economy into your caution. You walk away from the bull case.
Yeah, look, I think that the bull case was always that Goldilocks would persist into this year, and that was not our view. Our base case was that Goldilocks would be challenged, and of course the bear case is that you slide into something even worse than that. And I would say, as we talked in this program last time, we were leaning more towards the bear than the bull. So what's going on? As you mentioned, we now have a negative forecast for non-farm payrolls tomorrow. The question is it just an Omicron, kind of final pare back and hiring, or is it something bigger? We've had this narrative of fire and ice, and we think it's going to be icier. That doesn't mean recession. It doesn't mean negative payroll numbers for the next 5 months. But, the idea that we're not going to have some payback here from what was a spectacular, kind of rebound during the pandemic, we think is naive. And you guys were talking about something I think that's really being overlooked, which is this bifurcation between the lower income cohorts and the upper income cohorts. Without the government transfers and with this inflationary burden, they are the ones bearing it, and it's going to slow demand. So I'm probably a bit more cautious on consumption in the first half of this year than my colleagues and also my peers around the street.
Mike, you and the team believe that fears over growth will overtake fears over interest rate hikes. And I wonder how that separates you from the rest of the street when it just comes to sector allocation beneath the surface of the S&P at the moment.
So, I think most people would argue that, if we're going to have a slowdown, then you want to go right back into the, high multiple growth stocks. And the problem with that analysis, in my view, or that conclusion, is that a lot of the growth stocks are also going to see a payback in demand. I don't want to pick on one sector. I think it's pervasive across a lot of different sectors, but let's just take technology as an example. Technology is inherently a cyclical industry. I'm pretty old. I've followed the industry for a long time. And I remember when it was treated as such. And for whatever reason now, I think people view technology as being, that it's non-discretionary spending. It's not. And if, we see companies start to struggle with margins, there's going to be a pareback in spending and also a payback in spending from the overconsumption there too. So I think the strategy that we're employing right now is high quality, but with a more defensive bias than a growth bias, because the defensive stocks, the stability of earnings is going to be more protected. And they're expensive too, but they're not as expensive as some of the growth stocks still.
Mike, how far have we gotten to your bear case, given some of the pitfalls that we've seen, the lack of a safety net behind the likes of Facebook, and now the sort of commensurate losses that we're seeing in PayPal and also Spotify?
Yeah, okay, so let's get into it. The fire scenario, I think everybody's on board with that. In fact, people are probably paying attention too much to that. The bond market's priced for a lot of tightening, and the equity market is somewhat priced for that. I don't think that's the main issue. It's now the slowdown. And as I like to say, there's a little bit of Peloton in everyone, okay? There's a little bit of Netflix in everyone. There's a little bit of PayPal in everyone, right? And now maybe there's a little bit of Facebook in everyone. So it's just broadening out. So I think if you would ask folks a month or two ago, Peloton was a one-off. They were a COVID beneficiary. But the reality is that a lot of businesses benefited from this sort of pull forward during COVID and the stimulus. So this is what we got to get through now, this sort of reset on expectations for growth. And so our bear case, our base case for the year end is 4,400. Okay, not very exciting. Our bear case is 3,900. But remember, you got to overshoot to the downside. So even in our base case, we're going to probably trade sub 4,000 pretty easily sometime in the first half of this year. We probably get but more bullish on the index.
John, a surveillance question here, John. He's killing me. Mike Wilson needs to understand there's no Peloton in me.
I was wondering whether there was some Peloton in you, Tom.
I don't know what Mike's thinking. There's just
thank
no
you for the
Peloton.
confirmation.
Thank you. Continue with the bear case.
Mike, it takes me to my final question. In conversations like these with you in the coming 12 months, will we be talking more about single names with you, away from just year-end price targets on the S&P? Is that where the business is going at the moment for you, Mike?
Well, we've been doing that. As you know, John, we do have a focus list of 10 stocks, and it's performed pretty well. It has a macro overlay to it. And right now, that list is very defensively oriented. It's overweight REITs. It's overweight some of the services areas. It's underweight, consumer discretionary. There's nothing in there in consumer discretionary. So we absolutely think that this is the year of the stock picker. That's the title of our outlook back in November. That doesn't mean it's easy. Okay, because when the tailwinds are gone, picking stocks is harder. So that's the challenge, I think, for portfolio managers this year. But they have to do it. It's going to be idiosyncratic. You got to find the ones who don't have the payback in demand, don't have the overvaluation. Those are two variables to focus on, and you go from there.
Mike, let's talk about that group of names next time. Let's start there and do things a bit more different. I would love to do that. Mike Wilson and Morgan Stanley. Mike, thank you, sir. Thank you very much, as always. Tom, things are changing this year, and that's the drum a lot of people are beating.
All I can say is the separation here in the equity market and belief structure of the equity market is no different than the economics we've been talking about this morning. Pick whichever one you like, John.
Selection, stock selection. Lisa, Netflix down hard. Alphabet up loads. Apple, the same thing. And then Facebook this morning, 20%. They are huge moves.
I keep thinking there's a little bit of Peloton in all of us, although perhaps not Tom Keene. At what point, though, do these huge moves generate index-level types of outflows? And I do wonder, and that sort of goes to Mike's point about how we overshoot to the downside, and that, sort of cycle of washout hasn't happened yet. That's what it feels like.
There's no Peloton in me either, just to be clear about that.
John,
Tom, you've got good company, mate. Don't worry.
I want to make one point here.
Sure.
Which, you talk about stock selection. I looked at Pfizer as compared to Merck this morning. Pfizer from the beginning of the pandemic is up 52%, where Merck is flat. And that's a kind of individual stock differential. Granted, it's a pandemic, it's mRNA and all that. But this individual stock story is really front and center.
And if you want the pure play on mRNA, Tom, go to Moderna. And it's up even more over the years anyway. More recently, it's rolled over. That's been a story the last, 9 months, 6 to 9 months? Just looking at the chart right now, Lisa. Moderna really rolling over in the last 6 months.
Again, though, how much growth have we brought forward, right? And this is sort of the issue that Mike Wilson was talking about. No, it's important. And there's a lack of a safety net as the Fed removes accommodation, as the ECB remains pat, but the Bank of England removes accommodation. How much does that factor into a really choppy scenario that overshoots at some point?
Can we get a bull on? That was depressing.
You weren't happy with that, Tom?
No, it's fine. It's just, we need to go with a bull on next.
Just want to balance things out.
Balance it out.
Balance is important. Futures down 2% on the NASDAQ. On the S&P, we're down 1%. Facebook getting absolutely hammered. Tom will tell you another stock that large that's up that much. Can you do that, Tom, just for balance?
TikTok, killing it.
Crude, 87.12. We're down 1.3%. Christine Lagarde's got an interesting news conference coming up. The president of the ECB, 20 minutes away.
With the First Word News, I'm Rishika Gupta. President Biden says a raid by U.S. forces in Syria has resulted in the leader of ISIS being, quote, removed from the battlefield. He gave few other details other than to say that all Americans returned safely from the operation. Earlier, the Pentagon said that U.S. Special Operations Forces carried out a successful counterterrorism mission in northwest Syria. The Bank of England has raised its key interest rate as part of an attempt to contain inflation that's on course to top 7%. 5 of the bank's 9 policymakers supported a quarter-point increase to 0.5%. In a surprise move, though, 4 voted for a bigger hike to 0.75%. And it's not just interest rates that are rising in the UK. British domestic energy bills will soar 54% in April. That's a dramatic blow to households already suffering from inflation. The UK's energy regulator lifted its cap on bills in a response to that surge in gas prices. The government says it will offset half of the energy price hikes for most families. And all 3 of President Biden's nominees to join the Federal Reserve say they place a high priority on tackling inflation. Prices in the U.S. are rising at the fastest rate in almost 40 years. Philip Jefferson, Lisa Cook and Sarah Bloom Raskin appear before a Senate confirmation hearing today. In prepared remarks, Cook called the fight against inflation the Fed's most important task. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Friday, our first look at 2022 jobs.
I don't know anyone that forecasts unemployment to fall as quickly as it has.
Count on Bloomberg to get you the numbers and analysis you need fast.
The economy has created millions of jobs. We just can't fill them.
Finding people. It's the #1 challenge.
If we have a softening economy that takes the pressure off the Fed.
And what does it mean? It means inflation.
The January Jobs Report. Everything you need right here on Bloomberg Television and Radio.
12 minutes away from jobless claims in America. Then on to tomorrow, the payrolls report. We've barely talked about that this morning. There's so much going on. Futures down 1% on the S&P, on the Nasdaq 100. 4-day winning streak into Thursday. We're losing some now. We're negative 2.1%. Facebook getting hammered. We'll touch on that in just a moment. In the FX market, the ECB news conference coming up next. Shortly after jobless claims, we'll head over to President Lagarde in Frankfurt, Germany. Euro dollar 112.84, down 0.2%. Dollar making a bit of a comeback here. Just looking at cable, spike higher through 136, drop lower, back beneath it, 135.70 right now. I do think that line from Governor Bailey about this not being an inevitable march higher on rates, just pushing back maybe against this idea of rates going too much higher from here. And maybe the end point is lower. Who knows? The front end of the gilt curve is still a little bit higher here, Tom. Two's up 9 basis points to 1.1%.
It really speaks to the long march. It speaks to the x-axis, John. And I'm going to do the same focus with Lagarde here in 15 minutes, and we'll follow that press conference with Paul Sweeney and I on radio. And John, I'm sorry, she's got to define the long march of transitory.
Oh, yeah, please define it for me. I mean, President Lagarde's been calling it a hump, Tom, like a hump. So, I mean, over to you. Q&A is going to be interesting.
Over to you. It will be interesting. This is a joy. The day that Facebook went public, I had a wonderful conversation with David Kirkpatrick of the Facebook Effect and the wonderful Paul Kodrowski. Those are the kind of people Bloomberg Surveillance talks to about this odd social media space. Leadership there is Brian Weiser. He is Global President of Business Intelligence at Group M. The CFA is definitive on measuring the trends that we see in the advertising space across all this new. Brian, were you surprised by the Meta failure? As Dan Ives says, the unmitigated disaster that is Facebook?
wouldn't say overly surprised. I think I'm more surprised by the reaction that investors have. I think there's so many factors that are going on. The factors that Facebook cited are probably not the only ones going on. They're also probably being very conservative in the numbers that they're putting forward.
Martin Sorrell is trying to rebuild his ad business to take out traditional advertising. From this purview, it seems that Google, Amazon, and the rest own the high ground. Is traditional advertising, including on Facebook, is it dead?
No. I mean, to be clear, Google's numbers were just stellar. And I think when we see Amazon later today, the interest we see in retail media and related advertising is just through the roof right now. So no, not at all.
Although, Brian, do you think that Facebook perhaps relies too much on the advertising model, given that 98% of their revenue is derived from this source at a time when they have a lot of competition?
Absolutely, they are an advertising company, and I think that it's a mistake to think of them as anything other than that. It's also a mistake to assume that as an advertising company that in the long run you can grow faster than the advertising industry, which is a mid-single-digit growth business typically, right? It's been elevated. Pandemic probably helped them a lot, but are they more too dependent? Hard to say. I think that pushing into the metaverse ideas that we're talking about prior to yesterday, at least, they didn't seem to talk about that much. I mean, hey, probably a good diversification idea for them over a multi-decade period of time.
Brian, can you parse through what you think is the overreaction to perhaps this sort of existential crisis that people are looking at Facebook and saying perhaps it's obsolete and TikTok is going to take over and it's not going to really remain anything close to what it has been and is right now, versus just a cyclical business that is growing and has to grow at a pace that is commensurate with the advertising industry?
Yeah, what you said is the long term ultimately. I think they're still in a place where there's probably still a decent amount of growth to be had. But I think that the problem is that, Facebook's always had a lot of issues. I mean, the way in which they identify whether or not they're causing performance is always been a bit flawed. The number of users, it's always been overstated by about 20%. I mean, they tell you as much in the K and the Q. There's always been all these issues out there that I don't think investors have properly understood. The latest one, in the K, just out this morning, Thailand is now one of their top markets because Vietnam and I guess Japan are no longer in there. We don't even know what's going on with parts of the business in ways we need to know about them.
Brian, I know loads of people that have liked the stock. I know very few people that like the company. Is this just like a tobacco name now? It goes ex-growth. You don't really want to touch it, but it still makes a lot of money, and that's why people hold it.
It's not a bad characterization. I obviously don't talk to investors as much as I used to as a sell-side analyst, but certainly I think that would be a fair sentiment. I think that there are a lot of advertisers, and obviously that's who we do talk to all the time, who believe that Facebook contributes to the outcomes that they want from a media platform. And that's why there is still such a large business for them. But I think that your characterization is not wrong.
Brian, it's been too long. Come back soon, buddy.
Yeah.
I've really enjoyed that. At a Group M. Brian Weiser there. Tom, for so many people, the stock, it's a different conversation to the conversation, Tom, on the company. On the company, it's just almost toxic for some people.
John, I think you just nailed it. I mean, the heritage of Philip Morris becoming Altria and all the other PMI and all the international stuff, and you wonder if it's ever colored. What I wanted to ask Brian about, and we'll get him back on here, John, is does he need to do a Jack Dorsey and get somebody else in to run the company, and Zuckerberg take sort of a chairman kind of overview? I don't know. I'm not up to speed on it.
He strikes me as a very different character, Tom.
Yeah.
I just don't see that happen. Maybe I'm wrong. And by the way, we had this conversation.
Hello, traders. How are you doing today? If you're ready to trade today, here is your chance. We spotted a profitable trade will happen if we will execute order on British pound at 135.69.5. I'm placing an order to buy British pound at 135.69.5. Okay, if you want to trade British pound, please place your order. I will adjust it, 69.5. Stay with me and we will go through this trade together. Okay, I'll speak to you later, guys.
demographic. This is the question. You know, how much can they really generate enough to sustain them versus just becoming the AOL of 2021?
Is it just full of articles on GE and the Dow in the markets section? If you get that in the news feed.
I'll do some market research.
Futures on the S&P are down about 1%. On the Nasdaq 100, we're down by 2. Moments from now, in about 5 minutes, we'll head to Frankfurt, Germany, and catch up with President Lagarde of the ECB. A news conference that could be interesting, given what we've heard from the Fed going into March, and given what the Bank of England's done in December into February. Hike then hike again, as seemingly they've got no interest in doing the same. Euro dollar negative 0.2% at 112.81. Mike McKee's dropped into the studio because before we go to the ECB and before we go to Frankfurt, Germany, we'll get some jobless claims in America as well.
Anything else?
Just teeing us up for Payrolls Friday. You haven't seen the 9 o'clock hour.
Just throwing more
I've got
stuff.
a treat for you, Lisa.
All right, well, we'll be watching.
Just lots of stuff. From New York, this is Bloomberg.
Well, sorry guys, as you can see, we need to cancel it, moved up, and we didn't have a chance to buy. Let's see what's going to happen after. Maybe we'll have a chance it will move lower, so we will fill this order at a lower level. Okay, please remove your order to buy British pound. I'll speak to you later.
Estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
President Lagarde just stepping up to the podium in Frankfurt, Germany. Before we head over there to start that ECB news conference, let's head over to Mike McKee, seconds away from some jobless claims numbers. Mike, how you doing?
I'm doing okay. At least I'm employed at the moment. 238,000 initial jobless claims last week, which is, let's see here, it's down from the initial report of 260 last week, but and also lower than the 245 we were expecting. So good news. The problem with jobless claims, John, that we've had is that they have been distorted somewhat by the Omicron virus, because if you're not paid for work, even if you're a waitress and you don't go back to work because of the virus, you can file for unemployment benefits. So there's been a temporary bump, but people don't think that's necessarily going to last. The other big numbers out right now: productivity up 6.6%. It had fallen 5.2% or 5% is the new revision in the third quarter. So fourth quarter productivity takes a huge jump higher, which really pushes down on unit labor costs. Unit labor costs were up 9.3% in the third quarter, 0.3% in the fourth quarter, so suggesting some good news on the inflation front.
Mike McKee, thank you, sir. I believe the photographers have finished their work, Tom, in Frankfurt, Germany, from what I can see.
Well, they were
really
transitory.
crowd around
Yeah.
ECB President Christine Lagarde. That new conference is about to begin. ECB President Christine Lagarde looks a little bit lonely right now when it comes to central bankers. The Federal Reserve does not think it's transitory. The Bank of England clearly does not think inflation is transitory. The ECB president does. The Bank of England's hiking, the Federal Reserve is ready to go. The ECB looks set to punt that one further down the road. So I think, Tom, we can head over to Frankfurt, Germany, as they just hand over to the ECB President Christine Lagarde on their latest central bank decision and the path forward for the Eurozone economy and ultimately for monetary policy as well. Here's the President of the ECB.
So good afternoon. The Vice President and I welcome you to our press conference. The euro area economy is continuing to recover and the labor market is improving further, helped by ample policy support. But growth is likely to remain subdued in the first quarter as the current pandemic wave is still weighing on economic activity. Shortages of materials, equipment, and labor continue to hold back output in some industries. High energy costs are hurting incomes and are likely to dampen spending. However, the economy is affected less and less by each wave of the pandemic, and the factors restraining production and consumption should gradually ease, allowing the economy to pick up again strongly in the course of the year. Inflation has risen sharply in recent months, and it has further surprised to the upside in January. This is primarily driven by higher energy costs that are pushing up prices across many sectors, as well as higher food prices. Inflation is likely to remain elevated for longer than previously expected, but to decline in the course of this year. The Governing Council therefore confirmed the decisions taken at its monetary policy meeting last December, as detailed in the press release published at 1:45 today. Accordingly, we will continue reducing the pace of our asset purchases step by step over the coming quarters and will end net purchases under the Pandemic Emergency Purchase Program at the end of March. In view of the current uncertainty, we need more than ever to maintain flexibility and optionality in the conduct of monetary policy. The Governing Council stands ready to adjust all of its instruments as appropriate to ensure that inflation stabilizes at its 2% target over the medium term. I will now outline in more detail how we see the economy and inflation developing, and will then talk about our assessment of financial and monetary conditions. Economic growth weakened to 0.3% in the final quarter of last year. Nevertheless, output reached its pre-pandemic level at the end of 21. Economic activity and demand will likely remain muted in the early part of this year for several reasons. First, containment measures are affecting consumer services, especially travel, tourism, hospitality, and entertainment. Although infection rates are still very high, the impact of the pandemic on economic life is now proving less damaging. Second, high energy costs are reducing the purchasing power of households and the earnings of businesses, which constrains consumption and investment. And third, shortages of equipment, materials, and labor in some sectors continue to hamper the production of manufactured goods, delay construction, and hold back the recovery in parts of the services sector. There are signs that these bottlenecks may be starting to ease, but they will still persist for some time. Looking beyond the near term, growth should rebound strongly over the course of 22, driven by robust domestic demand. As the labor market is improving further, with more people having jobs and fewer in job retention schemes, households should enjoy higher income and spend more. The global recovery and the ongoing fiscal and monetary policy support also contribute to this positive outlook. Targeted and productivity-enhancing fiscal measures, as well as structural reforms attuned to the conditions in different euro area countries, remain key to complement our monetary policy effectively. Inflation. Inflation increased to 5.1% in January from 5% in December 21. It is likely to remain high in the near term. Energy prices continue to be the main reason for the elevated rate of inflation. Their direct impact accounted for over half of headline inflation in January, and energy costs are also pushing up prices across many sectors. Food prices have also increased, owing to seasonal factors, elevated transportation costs, and the higher price of fertilizers. In addition, price rises have become more widespread, with the prices of a large number of goods and services having increased markedly. Most measures of underlying inflation have risen over recent months, although the role of temporary pandemic factors means that the persistence of these increases remains uncertain. Market-based indicators suggest a moderation in energy price dynamics in the course of 22, and price pressures stemming from global supply bottlenecks should also subside. Labor market conditions are improving further, although wage growth remains muted overall. Over time, the return of the economy to full capacity should support faster growth in wages. Market-based measures of longer-term inflation expectations have remained broadly stable at rates just below 2% since our last monetary policy meeting. The latest survey-based measures stand at around 2%. These factors will also contribute further to underlying inflation and will help headline inflation to settle durably at our 2% target. We continue to see the risks to the economic outlook as broadly balanced over the medium term. The economy could perform more strongly than expected if households become more confident and save less than expected. By contrast, although uncertainties related to the pandemic have abated somewhat, geopolitical tensions have increased. Furthermore, persistently high cost of energy could exert a stronger than expected drag on consumption and investment. The pace at which supply bottlenecks are resolved is a further risk to the outlook for growth and inflation. Compared with our expectations in December, risks to the inflation outlook are tilted to the upside, particularly in the near term. If price pressures feed through into higher than anticipated wage rises, or the economy returns more quickly to full capacity, inflation could turn out to be higher. Market interest rates have increased since our December meeting. However, bank funding costs have so far remained contained. Bank lending rates for firms and households continue to stand at historically low levels, and financing conditions for the economy remain favorable. Lending to firms has picked up, supported by both short and longer-term loans. Robust demand for mortgages is sustaining lending to households. Banks are now as profitable as they were before the pandemic, and their balance sheets remain solid. According to our latest bank lending survey, loan demand by firms increased strongly in the last quarter of 21. This was driven by both higher working capital needs stemming from supply bottlenecks and increased financing of longer-term investment. In addition, banks continue to hold an overall benign view of credit risks, mainly because of their positive assessment of the economic outlook. So summing up, the euro area economy continues to recover, but growth is expected to remain subdued in the first quarter, while the outlook for inflation is uncertain. Inflation is likely to remain elevated for longer than previously expected, but to decline in the course of this year. We will remain attentive to the incoming data and carefully assess the implications for the medium-term inflation outlook. We stand ready to adjust all of our instruments as appropriate to ensure that inflation stabilizes at its 2% target over the medium term. We are now ready to take your questions.
Thank you, President. And today the first question goes to Annette Weisbach of CNBC. Annette, please.
Thanks a lot. President Lagarde, thank you for taking my questions. My first one would be, in light of that record inflation reading we've seen for January for the Eurozone, how did the discussion go in the Governing Council? Are there more frictions now, and is the camp of those who are calling for action is getting louder? And the second one goes on the market pricing in 2 rate hikes for 2022. You have been saying that a rate hike this year is highly unlikely. What are you saying now? Are you sticking to highly unlikely, or have you moved on? Thank you.
Thank you very much for these 2 questions, very pertinent questions. So, concerning inflation, with the upside surprise that we have seen first in December, second in January, I can tell you that there was unanimous concern around the table of the Governing Council about inflation numbers. And obviously the impact it has on the near term and the impact that it has on our compatriots in Europe. Because we know that the burden is first and foremost borne by those who are most vulnerable, most exposed, and who face the day-to-day hardship of having to put up with higher prices. So I can assure you that that concern was across the board and around the table in equal numbers. So we had a very thorough and in-depth discussion about inflation precisely. And we're focusing on the latest information we have, but also the impact that it will have on our medium-term outlook. And that is clearly something that will be examined in more depth at the time of our March Governing Council meeting, when we produce more projections, which we have not on this occasion, when we can harness all the latest data that we have, where we can also have more information about the job markets, about wages, and where we can really analyze in depth what the impact is on our medium-term projections. We are all driven by the same mandate, which is price stability. And we are all concerned to take the right steps at the right time. And I think there was also a concern and a determination around the table not to rush into decision unless we had proper and thorough assessment based on data and the analytical work that will take place in the next few weeks. So that's on your first point concerning the inflation numbers. On the other question of the rate hikes, you know, I never make pledges without conditionalities, and it is even more important at the moment to be very attentive to that. So, as I said, we will assess very carefully. We will be data dependent. We will do that work in March. And I think it will take us into the analysis of what are the drivers behind inflation in the short term, what are the drivers behind inflation in the medium term, and how the whole outlook and medium-term projections looks like. Let's not forget that we will continue doing so on the basis of our forward guidance, that we will continue to observe the sequence that we have agreed, and that we will be gradual in any determination that we make at the right time on the basis of data. Thank you.
Thank you very much, Madame Lagarde. The next question goes to Eric Albert of Le Monde. Eric, please.
Thank you very much for taking my question. A couple of hours ago, President Lagarde, the Bank of England increased its rate by 0.25%. 4 of the 9 members of the committee actually wanted more than that, wanted 0.5. You're going to tell me, of course, that different economies means different decisions. So could you tell me what is the difference between the 5.4% inflation in the UK compared to the 5.1% in the Eurozone? Why is it not the same course of action in the ECB? And the other question is about wage growth. What can you tell us about wage growth in the Eurozone? Do you see any sign of that? Are you worried about that side of things?
Back a little bit into history. The United Kingdom has had a history of much higher inflation than what we have had in the euro area. That's point number one. What is the critical difference now between our respective economies? The critical one, there are many other ones, but the critical one has to do with the labor market, where clearly there is a lot of pressure on wages, where there is scarcity of workers for jobs that are available, and where, I don't want to take a political stand, but I think that there was a lot of non-UK labor force that eventually had to leave the United Kingdom, which has not been totally replaced, and where the shortage of work is actually having a bearing on the forces of the labor market in the UK. So that's really, in essence, what is causing the significant difference between the two. On the wage front, what we are seeing, and that we can really celebrate, is that the euro area is at the lowest unemployment number it has ever been. 7% unemployed is a record number. The second aspect of that labor market is that our participation of employees in the labor market is back to the level where it was pre-COVID. So on those two accounts, we have good news to celebrate. What we are not yet seeing is a significant movement in terms of wage increases. And we are not seeing a lot either in relation to wage negotiations. And that normally should be the next step that we see, with lower unemployment, more people leaving the furlough schemes under which they were operating, and the output gap closing gradually, and economy returning to full capacity. We should see movement, and we are not seeing a lot of it yet. Now, of course, a lot of the information that we're getting statistically is backward-looking, but we are also very attentive to what is happening and what is likely to happen. That is actually taken into account to a certain extent in our projection numbers. But clearly what will happen in the next few weeks and what we can see, both for our March meeting and then later on our June meeting, will be critically important to determine whether the three criteria of our forward guidance are fully satisfied.
Thank you, President. The next question goes to Balazs Koranyi of Reuters. Balazs, please.
Good afternoon. Thanks for taking my questions. The first one is that from your guidance about standing ready to act, you removed either direction. And I'm curious about the significance of that, if there is a significance. But in the interest rate guidance you left, or lower, the two seem to be incoherent to me, because that would mean if lower is an option and you're not ready to act in both directions, then you're only going down. Surely you didn't mean to say that. The second question is about the quality of your projections. Do you maintain your full confidence in the ECB's projections? The track record of these projections have been quite mixed in recent quarters. And it seems to me that it's clear to me that the models are not equipped to be modeling a once-in-a-lifetime event. So what do you think about the projections going forward?
Thank you very much for your questions. On your first point, you've done a good reading of the various paragraphs that are included in our monetary policy statement, and it is a fact that we have removed the portion that says in both directions. And we now say the Governing Council stands ready to adjust all of its instruments as appropriate to ensure that inflation stabilizes at its 2% target over the medium term. I think as appropriate, which we debated within the Governing Council, captures the vast array of optionalities that we have available depending on the data that we receive, and as hopefully some of the uncertainty we have around clears off. So we thought that as appropriate was perfectly adequate to cover all the moves that we could take and all the optionalities that are available for us. I think based on recollection, because we debated that a little bit, the in either direction was inserted once to really indicate that there was a change of tack, and that we were no longer in that low inflation environment for such a long period of time, and that was inserted in the December monetary policy statement. We are clearly receiving data that inform us about the high level of inflation. Certainly the upside risk to our projection particularly for the short term. And that is the reason why we've thought that as appropriate would cover all the optionalities that we have. Now, I'm glad you're asking me about the quality of the projection by staff. It's actually interesting because as managing director of the IMF, I did had exactly the same questions in due course in my previous life. And what it means is that providing forecast, elaborating projections is a difficult exercise that is based on the assumptions that you make and on the models that you use. And I have full confidence that staff does its best to include all the sensible, reasonable, rational assumptions that they can. And I can assure you that they go through a whole array of scenarios, what if, what if, what if, what if. And they use the models that they use, that many of you listening to me are also using. So it is hardly surprising that most projectionists, most forecasters have also been surprised by the inflation numbers, in particular in December and January, because very few of them could have anticipated the energy shock, the massive shock that is hitting our economies around the world, but particularly so in Europe, where we are so vastly export dependent when it comes to our energy. So that has clearly an impact that was not anticipated because it was not in the assumptions. Now, all the work that is done by staff to elaborate those projections, all that work is also assessed by the Governing Council. And each and every governor of each and every national central bank is consulting with their staff as well. And their staff are feeding also data into the aggregate projections that we produce, at least 1 out of 2 every year. Sorry, 2 out of 4. But the determination is made by the Governing Council. And indeed, there is an element of discretionary judgment. You know, we don't take projections just at face value. And this is, particularly relevant in the current circumstances, given the level of uncertainty, given the geopolitical risks around, there has to be an element of judgment that actually belongs to the table of the Governing Council. Thank you.
Thank you, President. And the next question goes to Caroline Look of Bloomberg. Caroline, please.
Hi, thanks a lot, and good afternoon, President Lagarde. I just wanted to draw on your response to Annetta's question on rate hikes earlier and wanted to confirm, are you not willing to repeat today, as you said recently in December, that it's very unlikely that you will raise interest rates this year? And secondly, you were talking about how inflation risks are tilted to the upside, particularly in the short term. But could you give us some more thoughts on the medium term and specifically the assumption that inflation will fall below 2% and stay there in 2023 and 2024?
Okay, so on your first question about interest rate hikes, as I said, I don't make pledges without conditionalities. And I did make those statements at our last press conference on the basis of the assessment, on the basis of the data that we had. And it was, as all pledges of that nature, conditional. So what I'm saying here now is that comes March, when we have additional data, when we've been able to integrate in our analytical work the numbers that we have received in the last few days, we will be in a position to make a thorough assessment again on the basis of data. And I cannot prejudge what that will be, but we are only a few weeks away from the closing time at which we provide the analytical work, prepare the projections for the Governing Council, and then come with some recommendations and make our decisions. I think, it all goes back to how do we make our decisions? We make them on the basis of data. We make them on the basis of the forward guidance when it comes to interest rates. We make them gradually, because we're not here to rock the boat, if I may say. And we are going to use all instruments, all optionalities, in order to respond to the situation. But the situation has indeed changed. And you will have noticed that in the monetary policy statement that I just read, we do refer to the upside risk to inflation in our projection. So, situation having changed, we need to continue to monitor very, very carefully. We need to assess the situation on the basis of the data. And then we will have to take a judgment. So you had a second question, which had to do with what's my prediction about the medium-term inflation? Well, again, I'm very sorry to say, but we do assess risk to the upside for the near term, particularly for the near term. We're not excluding, but we say particularly for the near term. We will know better what impact it will have on the medium-term inflation. But let me just say one thing. We are getting much closer to target. And this is so because in the medium term, there are factors, drivers of inflation that are helping us finally reach, hopefully, that target. And that has to do with the labor market that I was discussing earlier. That has to do with the broad-based inflation that we have, which concerns more than 60% of the items. And it has to do with the inflation expectations, which, whether based on surveys or market-based, are now heading very close to or at target. So this is all good development. And I'm saying that with a concern, because I know how much hardship it imposes on all of us Europeans, and particularly those who have to fill up the tank and who have to put food on the table, because it is hard. Prices are going up very much at the moment. We see them continuing to stay high for a few more months, but then declining over the course of 22. And then our medium-term numbers, we will have more certainty at our March meeting.
Thank you, Madame Lagarde. The next question goes to Francesco Ninfole of Milano Finanza. Francesco, please.
Thank you. Good afternoon. President Lagarde, could you clarify what is the best way for the ECB to act when there is an increase in inflation driven mostly by supply rather than demand? In the Eurozone, of course, there are significant increases in energy prices, but inflation can be a burden on demand, as you've said before. Secondly, I have a question on fiscal rules, because in the last days, the advisors of the Italian and French governments have published some proposals on the Stability and Growth Pact. Have you seen them? What do you think of them? And in particular, what do you think of the proposal to transfer part of the ECB, of the government bonds in the ECB balance sheet to a European agency in order to give ECB more space for monetary policy? Thank you.
Well, thank you for your two very interesting questions. You know, I opened this press conference by saying how all governing council members were concerned about inflation numbers, which were at a very surprising level by all accounts, and whoever are the projectioners and the forecasters. Of course, we went into the analysis of what is it more supply? Is it more demand? We all know that monetary policy can have a stronger impact on demand, and that the impact on supply, particularly if it is imported supply, as is the case with energy price increase, is going to be more limited. But I would have a little caveat on that one, because clearly the longer it lasts, the higher the likelihood of second-round effect there will be. And in that case, obviously, monetary policy has a role to play. So I think that we are all concerned that we have a mandate which is to deliver price stability, which is to make sure that inflation is at target in the medium term, which is the strategy that we have adopted, all of us. And we know the limits of what can be done and when it can be done, but we know that action has to be taken when the conditions are ready for that. You referred to the editorial that had been jointly prepared and published in one of your colleagues' newspaper. And of course, I've read it. And we also have taken a view within the Governing Council of the European Central Bank concerning the Growth and Stability Pact, because we have an interest in how fiscal rules will be applied. We have an interest in the governance of the euro area, and we are very keen to see as much of a fiscal union as is possible, given that we have a monetary union, and that the current crisis has demonstrated amply that when monetary and fiscal policy work in intelligent synchronization, it can be very efficient. But I'm not going to pass judgment on a proposal or the other, however respectable the authors are. We have said, us Governing Council of the ECB, that we would like to see rules that are simpler, that are more user-friendly, that provide for counter-cyclical response. And we have also said that we believe that a fiscal capacity would be appropriate in order to respond collectively to shocks. So, you know, there are other proposals that are being floated, but the decision will ultimately depend on what the leaders are prepared to compromise and are prepared to accept. From our perspective, the more fiscal union there is, obviously the better for our monetary policy. Thank you.
Thank you, Madame Lagarde. And the next question goes to Martin Arnold of the Financial Times. Martin, please.
Hello, Madame Lagarde. Can you hear me?
Yes, I can.
Great. I asked this question in December. I'm going to ask it again, forgive me, but do you think the market in pricing several rate increases this year by the ECB has got ahead of itself? And secondly, can you tell us what your view is on the impact of tensions between Russia and Ukraine on the economic outlook, and particularly the outlook for inflation? Thank you.
Well, thank you very much. I don't know what answer I gave you to the December question, and I might be giving you a similar answer, although it will be in the light of different indication from the economic situation, and certainly different inflation numbers and different labor market numbers. But when it comes to interest rate hikes, we have a forward guidance which has been approved by the Governing Council, which identifies three pillars or three criteria, if you will, that need to be satisfied in order for rates to be hiked. And I don't want to insult you by repeating those three criteria, but I will, actually. So we have the inflation at target, which is 2%, well ahead of the projection horizon. We have second, the durability, so that we see it staying at target until the end of the horizon. And third, we need to see underlying inflation that is sufficiently strong to determine progress towards target. So we will apply these three criteria at each and every step of the way, and we will determine if and when they are satisfied in order to possibly hike rates. But don't forget that we also have a sequence. And the sequence is that we will not hike rates until we have completed net asset purchases. So I think, you know, what comes first comes first. We have to look at net asset purchases. We are conducting a step-by-step glide of those net asset purchases. We will determine in March what is the assessment, what on the basis of the data that are then available, and we will see what pace, what speed, what amounts we will apply to this net asset purchase programs for the rest of 22. You asked me a more political question on which, you know, I'm not going to take a political stand, but I will simply say that, you know, the geopolitical clouds that we have over Europe, if they were to materialize, would certainly have an impact on energy prices, and through energy prices, an increased cost throughout the whole structure of prices. But it would also impact growth as a result of reduced income and possibly, as a result, reduced consumption and deferred investment. So the pure economic impact would be certainly significant than what we are seeing at the moment in terms of prices. So we are very attentive to that. And by the way, we include that in our scenario when we prepare the projection and the work that is submitted to Governing Council members at the time of the next Governing Council meeting. I will say separately that peace is a lot better than any kind of war from an economic point of view, and I've seen that in other parts of the world in previous lives.
Thank you, Madame Lagarde. Next question goes to Mark Schröers of Börsenzeitung. Mark, please.
Yes, hello. Thanks for taking my questions. The first one is on inflation. You mentioned several times now the upside surprises in inflation in December and January. Does that mean that the December projections from the ECB staff, that they are already outdated, especially the projections that inflation will fall below 2% in 2023 and 2024? And my second question is on the degree of monetary policy accommodation. If inflation is significantly higher than expected, this means that real interest rates are lower than thought. So monetary policy is more expansionary than thought. Isn't that in itself a reason to recalibrate monetary policy and to tighten monetary policy? Thank you.
Well, thank you for your two questions. On the latter one, it's obvious that monetary policy has to continue to support the economy. And you mentioned it yourself, the whole panoply of instruments that we use that are currently working is also explaining some of the good results that the economies are showing at the moment. On the upside surprise, we did not only use the word upside in relation to surprises, we used it in relation to risk. Risk is to the upside in our projection. We hardly ever, I don't know, I'd have to double check in the last 20 years, we may have in the past, but in the recent past, we have not actually mentioned, we have not included in our monetary policy statement the characterization of risks in relation to inflation. So I think that is a very explicit indication that it might very well be significantly higher than what we had expected over the course of the year, and possibly higher than we had anticipated at the end of the year. So risk is to the upside, in particular in the near term.
Thank you, Madame Lagarde. And the next question goes to Johanna Träg of Politico. Johanna, please. We can't hear you, Johanna.
Can you hear me?
Yes.
Great, thank you very much. I've got a quick question on your March projections that you've highlighted now repeatedly. If those updated forecasts show inflation exceeding your 2% target in 2023 and 2024, would then, in your personal view, that be a reason to start slowing bond purchases earlier than currently suggested? Thank you very much.
Well, thank you for your pointed question, but I'm not going to speculate on what the Governing Council will decide. I think you have the answer, but I'm not going to here speculate on what the decision will be.
Thank you. The next question goes to Andres Stumpf of Expansion. Andres, please.
Hello, can you hear me?
Yeah, very much so.
I was wondering, in light of these new events, that if you have measured any kind of what degree of monetary contraction could cause the decision of ending the special rate period of the TLTROs.
Actually, we have not discussed TLTROs at all in this particular Governing Council meeting. And it's one of the items that I'm sure we will debate at our March meeting or later, actually. Because I think they continue. They end in June 23, if I recall. Huh? Yeah.
Thank you. And the next question goes to Mark Boinderman of NSA Handelsblatt. Mark, please.
Yes, thank you very much. In the beginning of the press conference, you said that there was a unanimous concern within the Governing Council about inflation. Just to be sure, does it mean that the monetary policy decision taken today was also taken unanimously? And my second question, if I may, to what degree does the scenario or the risk of rising bond spreads determine the pace of normalization of monetary policy of the ECB, especially given the fact that the sovereign debt has exploded so much during the pandemic? Thank you.
Thank you very much. I think I said that there was general concern around the table about inflation and the impact it has on our fellow Europeans. Equally, there was general consensus about the outcome of our decision. I wouldn't call it a monetary policy decision, so to speak, because what we are doing is we are continuing the normalization of monetary policy, and we are considering what will possibly happen and what options we offer ourselves, what optionalities will be around in response to the uncertainty at future monetary policy meetings. That's what we did in depth and very thoroughly today. But there was general consensus on these issues around the table, I can assure you. Now, you asked me a question about the spreads. I would like to just observe that we are not seeing any such development. And while yields have moved up, spreads have not widened in any significant manner. So we very much look into these matters very carefully, and we have no reason to believe that it is going to be different. And if it was, we are obviously going to respond, and we have all the tools, all the instruments, and the adequate flexibility if it is justified. Thank you.
Thank you, Madame Lagarde. And the next question goes to Klaus-Rainer Jakisch of ARD Television. Klaus-Rainer, please. We cannot hear you, Klaus-Rainer.
Can you hear me now?
Yes.
Oh, I'm sorry. Good afternoon. Thank you very much for taking my question. Ms. President, I would like to focus on the energy prices. If I listen to you and your colleagues, one always has the impression that energy prices is something a central bank can't do much about it. It has to be taken, and this is partly taken as justification for the current monetary policy. On the other hand, one could argue that the current policy is leading to the fact that the dollar is rising quite significantly against the euro. And since most energy, or many all energy, is being calculated in US dollar, it basically is another factor why energy prices are rising. So there is a criticism that one could argue that the current monetary policy stance of the ECB actually is fueling inflation rather than combating it. I hope you won't just say we don't focus on the exchange rate, but what do you say to this criticism? Thank you very much.
But thank you very much. And it is the case that the very high inflation numbers that we observe are at least 50% caused by energy prices. Oil, gas, electricity, and they all interrelate, gas having a stronger bearing than in previous years because of the price mechanisms depending on the length of contract and all the rest of it. I will spare you the details. But 50% of the current inflation is caused by energy prices. If the ECB was to, first of all, reduce and finish its asset purchases, then raise interest rates in short order, do you think it would have any impact on energy prices? No. It is not in the ambit of monetary policy to decide the price of the barrel that is organized predominantly outside of Europe. Now, true that most of those contracts are in US dollars currency. But if I look at the significant appreciation, depreciation, it varies a little bit. The euro has depreciated a little bit. I don't want to, be in the wrong numbers, but it's no more than 3% over the course of the last 12 months. So I don't think that, we can attribute to the European Central Bank the high cost of energy, which impacts 50% of the inflation and the price paid by the consumers. Having said that, the European Central Bank and its governing council at large are focused on its mandate, which is price stability. But we are going to stick to the objectives that we have, that is set by the treaty, that is price stability at 2% in the medium term. And believe me, as soon as it is required and the conditions are satisfied, we will act because it is our duty, and we shall do so.
Thank you. Thank you very much. Next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Good afternoon, and thank you for the opportunity. President Lagarde, I have two questions. The first question is on the lower bound. If inflation were to be too high relative to the 2% target, the ECB would respond. And your response will come from the lower bound and from negative interest rates, which is very exceptional. Can you tell us how the central bank, the ECB, can respond to higher inflation coming from the lower bound? And my second question is on your step-by-step approach. The Governing Council expects net purchases to end shortly before it starts raising the key ECB interest rates, and that is APP net purchases. What does this shortly before mean if inflation was going too high for too long? Thank you.
Well, how do you hike interest rates? By hiking interest rates. And clearly, we will have a very sophisticated, determined approach and analysis to doing that. And we will only do that in the sequence that we have fixed for ourselves and which has been agreed, which is that we will look at net asset purchases first, gradually, okay, on a data-dependent basis. And then we will look at interest rates. Now, you asked the question about net asset purchases, and not sure exactly what your concern was about the net asset purchases and what is the what was the question?
What shortly before?
Oh, shortly before. Yeah, of course, shortly before. Shortly before is probably a little shorter than just before. And that, again, is going to be in the estimation of the Governing Council, data dependent and based on the assessment that is conducted. But I would say this, we are not there yet for the reasons that I have just mentioned, which is that we will be very faithful to our sequence. We are still conducting net asset purchases. We will stop the pandemic emergency program net assets in March. And then we will look at the net assets under the APP. So don't assume too much in terms of immediacy of hikes. We will not be complacent, but we're not going to be rushed into a process. We will follow the sequence that we have set for ourselves. We will verify the forward guidance criteria, and we will be gradual in whatever we do.
Thank you, Madame Lagarde. And today's last question goes to Jean-Philippe Lacour of Jean-Philippe Lacour of Agence France Presse. Jean-Philippe, please.
Okay, thanks a lot, Wolfgang. Good afternoon, Madame President. So it's very crucial to avoid the so-called second-round effects in the setting of wages and prices. And in times where we see people going on the street and to defend their purchase power, especially in France, would you go as far as to call the unions to wage moderations in the coming period to avoid these second-round effects, which are not yet there, of course? And the second question is, we have an interview of World Bank Vice President Carmen Reinhardt today in the Spiegel, using harsh words toward the central banks, telling they are only independent on the paper, and for that she said that the level of public debt is so far so high, then the central banks are so hesitant here. What's your take about this? Thanks.
Well, on the latter question, I have not seen what Carmen has written, so I'm not going to comment on that. She's an expert on sovereign debt, and she has held that view for a long, long time that excessive sovereign debt is a great burden and should be addressed by sovereigns. So I'm not going to challenge or second guess her analysis. I know this is her field, and I'm not surprised that she's addressing that in her capacity as chief economist of the World Bank, and clearly, I'm sure, focused on emerging markets and low-income countries. On the second round effect, don't get me wrong. What we are saying is that we are not seeing wage increases that would be likely in the conditions of the markets as they are, where we are seeing unemployment as low as it has ever been, where we are seeing participation back to the level where it was pre-COVID, and where gradually the output gap is closing, and there is less and less slack in the economy. So we are waiting for that movement on wages. And our duty, of course, is to make sure that through a second round effect that would not be addressed by monetary policy, inflation would run out of control and would spiral. This is not what we are seeing, and we certainly don't want to see it. But I'm not here saying that there should be wage moderation. There is clearly an adjustment to be had, which I'm hoping we will see in the course of 22. That would be the economic logic of what we are seeing at the moment. And by the way, as I'm finishing on that question, I think we should be a little bit cautious about what I'm hearing a lot, which is constant comparisons between the US and the euro area, the Fed and the ECB. We are really operating in different environments with different economic data. Just to give you an example, our demand here in the euro area is pretty much back to where it was pre-COVID. In the US, it is 30% up. Ask yourself why. Because of this massive fiscal stimulus that the US economy has had. Unlike the euro area, where it has been more moderate, not excessive, and which is producing the sort of measured pace at which some factors are significantly improving. So, suffice to say that I wish you all a very, very good day. Thank you.
Thank you very much. That brings us to the end of our press conference.
The situation has changed. The ECB president there, Christine Lagarde, out of Frankfurt, Germany. In much of the last decade, over the last 10 years, that is the closest this ECB has come to even thinking about raising interest rates. That's the opening bell in New York City. Good morning to you all. Let's whip through it. Euro-dollar spikes higher, up 0.7% on euro-dollar 113.83. As we bring forward the prospect of interest rate hikes of the ECB, at least the thought of it. This is what it does to the German debt market. Switch up the board and get to Bunds. Bund yields higher at the front end and right through the curve. On twos, up 6 or 7 basis points. Now negative just 39 basis points on German twos. The depot rate of the ECB still negative 50 basis points. The problem might be in Italy. Switch up the board and get to BTPs. Your 10-year yield in Italy higher by 15 basis points. At the front end, up by 14. At the epicenter of this news conference, these comments from President Lagarde on inflation.
There was unanimous concern around the table of the Governing Council about inflation numbers. We are all driven by the same mandate, which is price stability. And we are all concerned to take the right steps at the right time.
That got your attention. This is how she clarified those concerns.
What I'm saying here now is that comes March, when we have additional data, when we've been able to integrate in our analytical work the numbers that we have received in the last few days, we will be in a position to make a thorough assessment again on the basis of data. And I cannot prejudge what that will be.
Let's get across to Manus Cranny in Frankfurt, Germany. Manus, I'm so happy you're with me today. You and I have covered this for a long, long time together. I'm not saying they're there, but Manus, they're getting closer.
To quote Lagarde, I don't make pledges without conditionality. She was asked, would she repeat, very unlikely to raise rates? That's the trigger phrase that we were all looking for. She wouldn't repeat the phrase. She warned on conditionality. She bought herself time. There's a lovely line on the blog, which is that the bond market, as you said, 2s, 5s, 10s, all sweeping higher from Germany down into Italy. The belly of the curve is moving the most. And this is where the bond market is laying down the gauntlet, because they're reading this situation has changed and inflation is tilted to the upside as being a paraphrase for I've got optionality, but I'm not going to do anything until I make the new decision in March. I told you, Jonathan, it's two very different economies, and she was very definite about that between what's going on in your economy in the United States of America and here in Europe on a fiscal and a wage front. But the euro is flying higher, and it looks like this market is going to be pushing further and harder and baying for higher rates. Jonathan.
Manus, just a final question from me to you. There is a process here, and before we get a rate hike, we've got to wrap up QE. How important is that going to be in the coming months as we start to hear from the ECB speakers?
Jonathan, that's a global issue. It's not just the ECB. They've got to roll off their emergency PEPP. That's their pandemic purchases, then sort of cozy the market a little bit with APP, asset purchases, at 40 billion. So that's, as it were, the blanket that they're going to offer to this market. But, Jonathan, it's about whether you've got active QT, passive QT, or something that we really just don't quite understand yet. And that's what Credit Suisse are talking about this morning. You could have an ugly version of QT, Jonathan, and we just simply don't know whether they're going to do that in the US or here. I think she's buying time, but the rates market is showing utter impatience.
It's screaming right now for something. Manus, thank you so much. Manus Cranny out of Frankfurt, Germany. They have the line, That T word in Frankfurt, crumbling, transitory. Can you hold on to it? In Frankfurt, Germany, the ECB right now. Joining us, a fantastic panel. Invesco's Alessio De Longis, Credit Sites, Winnie Caesar, and Eric Nelson of Wells Fargo. Winnie, first to you, your reaction to that news conference over the last 60 minutes.
I think it's not a particular surprise that we are extending our focus on inflation across the globe, because so many of the inflationary drivers are global and related to the pandemic, supply chain, commodity prices. I think there are some nuances in that conversation around addressing inflationary pressures through rate hikes may not be the best mechanism to really bring down inflation. But just given how low yields were across the globe, seeing this type of rates market volatility is not a particular surprise if investors continue to perceive central bank messaging as incrementally more hawkish.
I want to turn to you, Alessio. It's been a while, but before we get there, they've got to wind down QE. Alessio, is that the next step here before we run away with a rate hiking cycle at the ECB?
For the ECB strategy, certainly it's the best approach and it's the best way to go. This is the most meaningful hawkish innovation coming from the ECB in a really, really long time. So they really cannot afford to get this communication wrong. They cannot afford to be confusing about the sequencing. Hence, the postponement to March makes absolute sense given their delivery process. It's a market that is pushing central banks as they always do. Bond markets lead central bank actions, not the other way around. And bond markets are telling central banks globally, look at where we were in Q4 of 2019 before the pandemic. We ought to take rates back to that level and then reassess. Because ultimately, inflation is above target, very well above target. And the growth side of the economy, the unemployment side of the economy has adjusted. So it's very difficult to continue to drag your feet at this stage.
5-6 minutes into the session, one thing stands out apart from the ECB. Facebook, as it has been all morning, down by more than 20%, dragging down the index on the S&P. 6 minutes into the session by 1.4%. Big weighting on the Nasdaq coming into today. It was 5% of the Nasdaq 100. We are lower there. We are down hard. I want to bring in Ed Ludlow from San Francisco for a little bit more on this from the West Coast. Ed, a disappointment. We saw it happen to Netflix. It happened to Facebook after the close yesterday.
I mean, what do you even say? We've just lost more than $200 billion of market value, and you ask the question, is this just killed the rally in tech stocks and equities? And it's dragging the rest of social media and advertising stocks down with it, right, John? Come with me straight into my Bloomberg terminal and look at this chart. This is the story. This was the quarter that Facebook stopped growing. The yellow bars are the quarterly monthly active user growth. The blue line you see down the bottom of your screen says zero growth. And we all got together last night, the editors and beat reporters, and said, has anyone ever seen this? And the answer, John, is no. Headwinds on the growth, TikTok and YouTube. They're stealing the attentions of young people who are no longer going to the Facebook platform, but they're also impacting the growth of Facebook or Meta's other platforms, Instagram and Reels. So this is a big problem for the company.
Ed Ludlow on the West Coast, a big problem for the company and for anyone who holds the stock right now. In DC, the Senate Banking Committee holding a confirmation hearing for President Biden's Fed nominees. I understand that the Republican Senator, Pat Toomey, speaking right now. Let's listen in.
Maximize the speed and safety of a move into a sustainable, durable, net zero economy and away from climate change disaster, we need to use the financial regulatory apparatus to engage financial markets and financial institutions in affecting both direction and pace, end quote. In June of 2020, the Saris report came out and you wrote, and I quote, at the very least, we must rebuild with an economy where the values of sustainability are explicitly embedded in market valuation. This transformation will come in part from urging the leaders of our financial regulatory bodies to do all they can, which turns out to be a lot, to bring about the adoption of practices and policies that will allocate capital and align portfolios towards sustainable investments that do not depend on carbon and fossil fuels, end quote. How is that not advocating that regulators pressure the financial institutions to allocate capital the way the regulators want?
Well, it is, of course, not the role of the Fed to be directing credit allocation. They do not choose winners and losers. The way supervision works is by looking at risk, and by looking at risk wherever it may arise. You look at that risk, and you have to do it in a very, honest way, and ask yourself whether there is any correlation between that risk and the ability to hurt a financial institution.
Are you saying you no longer hold these views that you've stated about allocating capital as a result of your perception of this risk?
My views have been consistent, Senator. The Fed should not pick winners and losers. They should not be exposing taxpayers to undue risk.
Well,
so
okay, I'm sorry, that there is no reasonable reading of these articles and speeches that can come to a conclusion other than that you want to be allocating capital away from those industries that are generating large amounts of CO2. I'm sorry, I know you're saying something different here this morning, but that's not what you've been saying in writing for several years now. Let me move over to Professor Cook. I've heard you talk about the importance of getting inflation under control, but we had a phone conversation a couple of days ago. In that conversation, I specifically asked you whether you agreed with and supported the Fed's recent decision to gradually begin the process of removing the ultra-easy money policy, or whether you thought they were acting prematurely. And what you said was, well, somewhere in between. So I'm wondering if you can clarify that. But let me ask a simple question. Do you now support the Fed's current path of accelerating the tapering and moving on to a series of interest rate increases over the course of this year?
Senator, thank you for that question. I am certainly, when I think about these issues, I would like to look at the data and evidence that would be at one's disposal, if confirmed, to be able to make a decision about this. So I did say it was somewhere in between before, and I agree with the Fed's path right now as we're speaking. But when we get to a decision point, I would look to the data, the evidence that would be made available at that time.
Okay, well, there's a tremendous amount of data that's out there, right? I mean, there's no secrets or mystery about what the Fed's monetary policy is at any point in time. There's no secret or mystery about economic data generally. There's thousands of people across the country that are constantly analyzing it. It seems you've shifted from the in-between answer to now saying you support what the Fed's doing. It's confusing to me, and so could you give us some sense of how you view the policies that are available to the Fed, how you think about what we should be doing at this moment? Have your thoughts on the Phillips curve change given the developments in recent years? Are you concerned about the change in what's happening with the shape of the yield curve? Do you think exchange rates are an important mechanism? How do we get inflation under control?
Thank you for that question, Senator. I understand that every day Americans are suffering from high inflation. This is something that I learned a lesson about more recently, probably than most people. I've lived in countries and advised countries in a situation of hyperinflation. So I am motivated by seeing the suffering of workers, of businesses, and just trying to plan their everyday lives and facing an inflationary environment. The way I would think about it would be, along with, if confirmed, along with the deliberation. So you're right, there's a lot of data available, We don't have access to all the data the Federal Reserve has, but we have a lot. And what we don't have access to is the deliberations at the time that they're being made. And I work collaboratively. I'd like to hear arguments as they are being made. And with respect to the shape of the Phillips curve, what we know in economics is that this is an open research question. We know that there's a trade-off between unemployment and inflation, but we don't necessarily know what that relationship is. And in times of uncertainty, and this is sort of my specialty, in places of uncertainty in emerging markets and developing countries, what we know is that we have to be patient with the data. We have to ask about the data, whether the data have changed, if they are reliable, and still valid. So I would make sure that I pose questions of the data we were receiving and engage with the deliberations with my colleagues with an open mind, if confirmed.
Thank you, Mr. Chairman.
And thank you, Senator Toomey. Senator Reid from Rhode Island is recognized.
The Republican Senator Toomey of Pennsylvania questioning the White House Fed picks in the Senate Banking Committee testimony hearing. Let's get you to Michael McKee for a little bit more on this. Morning, Mike. We've got to talk about this and the economic data that drops in about 10 seconds.
Yeah, we got a lot going on this morning, John, that will affect trading. We're waiting now for the market services and composite PMIs. They had slowed in their preliminary numbers. The final numbers for the month of January just out, with services at 51.2. That's up from the 50.9 preliminary. And the composite at 51.1, up from 50.8. So as the month went on, it appears conditions got a little bit better, particularly in service industries. May not affect what people think, probably won't affect what people think will happen tomorrow with the January jobs report, John, but it is an indication that there probably was an Omicron impact that may be fading now.
Mike, tee us up for payrolls tomorrow. What a fascinating data point for a lot of people to get through.
It is fascinating because there's a feeling that we may even see a negative number because at this point, the Omicron variant kept a lot of people home. Now, the forecast consensus is 150,000, and you notice the other numbers don't move from last month. So it looks like stasis for the committee. It's a very, very wide dispersion from 250,000 jobs all the way down to negative 400,000 jobs in terms of what people think may happen this month. And there's the cluster is around 120 to 150. So we'll see if that turns out to be correct. But I do want to point out one change. After that big ADP report yesterday, the big drop in ADP, look at what happened with Morgan Stanley. Morgan Stanley went from 235,000 positive jobs to a negative 215. So it does look like some minds were changed on Wall Street by the data as they come in. And if we get anything like a negative number, be interesting to see how Wall Street reacts, whether they've priced this in or not.
I read that note from Ellen Zentner last night. Fascinating stuff. Mike, thank you. Back with us, Alessio De Longis, Winnie Caesar, Eric Nelson, thank you for your patience, sir. We've left you out. I'm going to come to you now. Eric, talk to me about the situation in Europe and the United States and why the central bank response at the moment seems to be so different.
Well, John, it's been different for a long time, right? Particularly in Q4 and earlier this year, we had a massive shift from the Fed toward more hawkishness, 4 to 5 hikes, possible balance sheet reduction, and the ECB was still hanging on to will they or won't they end the pandemic emergency purchase program. That is shifting, though. Just as we heard from Lagarde this morning, the situation has changed in Europe. So there is, in contrast to what we saw back in 2014, 2015, some degree of convergence, or at least co-movement, between the U.S. and the European central banks. The big question, though, in my mind is, how high can these central banks get in terms of their terminal rate? To me, the ECB is about getting back to zero, whereas the Fed, I think, can hike 4 or 5 times, start balance sheet reduction, and then keep going. So to me, that means that Euro over time is still biased lower, even if it moves sideways in the short term.
In the short term, right now, we're seeing some massive moves in this market. Facebook down by 26%. This is a monster move in the equity market. Alessio, I want to come to you. I saw this with Netflix. I'm seeing it again with Facebook. These are super caps. They're mega caps. Alessio, they're moving like penny stocks off the back of earnings. And I wonder for you whether you look across the equity market right now, whether these are single name stories or whether there is a broader story here off the back of it all.
Well, right now in the short term, I think there is a little bit of both elements. Obviously, having had earnings releases on these specific names, the idiosyncratic factor, the idiosyncratic component overnight today is massive. What is the other side of it? Because of the global hawkish rhetoric by central banks and the bear flattening that we're seeing across many, many curves, this is, in the short term, runs the risk of becoming a little bit also of a broader theme. And the broader theme is expensive growth companies see a valuation derating because those cash flows are now being discounted at simply higher interest rate. So that's a little bit where the nexus of these two themes really come together. Now, on a forward-looking basis, we think that as long as we don't get a bear steepening in the curve, in other words, where rising bond yields are led really by the long end of the curve, we think that a return to quality outperformance over value. And by quality, we mean not necessarily expensive growth stocks, but rather large profit margins, large return on assets, coupled with low volatility characteristics, will allow mega caps and large caps to outperform small caps, mid caps, and value. Because ultimately, we're going into an environment of flattening yield curve, tightening financial conditions, and slowing growth. I would still choose quality over value.
Winnie, I want to come to you on both what we're seeing in the equity market and in credit too. We're seeing some real-time destruction to some massive companies, losing close to $200 billion worth of market cap. Click of your fingers, just like that. We've seen some companies add just as much. Alphabet yesterday was on fire, Apple the week before. Winnie, do you see anything like this developing in credit? This kind of destruction, these kind of big moves?
In credit, the type of destruction that we've seen has been material, not to the extent as in the equity market, but January in both U.S. investment grade and high yield was the worst start to the year on record, and on a total return basis ranks in the top 20 for both asset classes for worst monthly return performance. So we are seeing some erosion on returns and some dispersion across the market. But like equities, it's been very technical and rates driven, with kind of a repricing of expectations of where rates are going to go, rather than this pure fundamental, liquidity is being cut off, we're going to see downgrades, we're going to see defaults. That has not materialized yet in the credit markets. So I think that there are some similarities, but credit in general has been a little bit better behaved, which actually is a kind of encouraging sign for equities longer term.
Eric, can I pick up on that with you and just get a final word on it?
Yeah, John, I think the key thing for the broader market here is the training wheels are off. The central banks have shifted in a big way, and it's been a global phenomenon. So whereas at the end of last year, we were looking at a very favorable both fiscal and monetary environment, that's no longer the case. So we're likely looking at more volatility in store this year, more back and forth moves. And to me, that supports more curve flattening and more dollar strength.
Thanks to all three of you for your patience this morning. A ton to get through, I know. Winnie Caesar, Eric Nelson, Alessio De Longis. We'll get you back on soon for a longer conversation. Ed, I wanted to save about 90 seconds for you on the West Coast. Ed Ludlow joins us now, just to talk about what's happening with this name, Facebook, down 25%.
Yeah, headwinds to user growth, which is competition like we talked about a moment ago, John, and headwinds to revenue growth. Ad spending is down, suppressed by supply chain issues, suppressed by the Omicron variant. Because of the Apple privacy tracking changes, small businesses, which we forget is a mainstay for the Facebook platform, were confused because they didn't have the data available to plan their ad budgets. That's one thing, but read across Wall Street, right? And Luke Capital Markets say, while financial results were not terrible, the outlook was. The market spooked. But you also look at the longer term, right? And the market coming to the realization that the metaverse isn't here. The metaverse is distant, but it's very expensive. That unit, Facebook Reality Labs, posted a loss of $10.3 billion in 2021. Bloomberg Intelligence saying that 2021 loss will translate into 10 percentage points of margin erosion in 2022. You look at JP Morgan, one of the biggest bulls on this stock since it IPO'd in 2012, downgrading. How much pain threshold is there, John, for this?
Ed, thank you. I have no idea. We're down 25 on Facebook. We're down 5% on Amazon. A little bit later after the close, we get Amazon. And given what's happened with the price action recently, if you don't give a good guide, a good forward look, you get hammered. Facebook, a big example of that this morning. Up next, we'll run you through the trading diary. It's not just Amazon you need to look for. It's also payrolls too. That's the big one tomorrow. From New York City, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Five minutes into the session, it's tough out there. On the S&P, we're down by 1.6%, down more than 2% on the NASDAQ. Here's your one big reason. Facebook, after the close yesterday, coming into the session now, down 25%. Biggest one-day drop in the history of this company as a public company, down more than $200 billion in market cap. Just like that. That's the price action. Here's the trading diary. More earnings after the ban, including Amazon on Friday. The main event is payrolls tomorrow in America. Looking ahead to next week, the trade balance data Tuesday. The big one, CPI. Another reading of that and additional jobless claims out on Thursday, plus tech earnings throughout the week with Twitter still to come. From New York City, it's one of those. Deep breath. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employer's winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America.